All right, 10 of 5. So let's begin. So welcome everyone to our little webinar. My name is Bikesh from Lead Ventures, and today I'm going to speak about one of our favorite topics, fundraising 101. Next week, we do have another session on pitching. So if you haven't signed up for that, please do so. As I said, this talk will run about 2 hours long. If you have any questions, feel free to just drop it in the chat, and my colleague Max will help answer those questions. At every point of a section break, I will kind of pause and maybe take questions live if there is any need. I'll go through some of the questions that was asked, and then we'll take it from there. So welcome again. Let's have a look. Oh yes, today is World Entrepreneurs Day, August 21st. This is a day we honor all of you visionaries who are trying to take an idea, a crazy idea, and maybe make it into a viable business. And this is what keeps us going. This is why we've been investing in local entrepreneurs for the last, 12, 13 years. I've forgotten how long it's taken us to get here. But essentially, today is your day, and hence why we want to come up with these talks and see how can we help you navigate fundraising, because that's always quite a tricky situation here, especially in Malaysia. A little bit about us, if you have not heard about us. So we were officially the first accelerator in the country. I think we started in about 2012, officially registered. The accelerator, or rather the pre-accelerator called Alpha Startups, has been running since 2014. We are way over batch 60, 62. I have no idea which batch we're on right now, but no, we try and run at least 4 batches a year, and that many years we've been in. We've trained thousands of startups that have gone through our program, not just in Malaysia, but the region. And eventually we find really interesting ones to invest into. And we invested in over 60, 70 startups now, not just Malaysia, but the region. And recently we've also expanded our investments to UK and even the US. We focus on the very first check, the early stage checks, which is called pre-seed. And today we're going to talk about that whole gamut of funding 101, and we'll talk about what even that means. We've had many exits. I think we have about 5 exits and 6 exits in total already. And exits doesn't always have to be towards a corporate. Sometimes you get really good founders running the business, not thinking about raising anymore, and they've come back to us and just bought us back out at 5, 10 times or whatever we put in. So really excited to see great entrepreneurs being able to scale not just technology, but non-tech businesses here in the country too. We also help companies eventually fundraise further, post pre-seed, obviously. And that's where we have our licensed equity crowdfunding platform called Lead Capital. So we're registered with SC, and we basically help certain entrepreneurs raise further funding post our programs. So that's basically what we've been doing. If you kind of map out that whole journey we had across the last decade or so, we've always been building this building blocks, I would say, to help entrepreneurs navigate what we call the valley of death, from picking better ideas to work on, working with partners to get revenues, funding them initially, find them further funding, linking up with corporates for innovation, eventually fundraising with them on a crowdfunding platform. We've been building this entire gamut of solutions or products or service offerings to kind of help navigate fundraising in this particular country. So that's basically us. There's 2 slides on that. So today, by noon, I hope to be able to answer some of these questions. And most of these are questions that you were basically putting when you registered, right? But should you even raise at all? Let's try and kind of uncover that aspect. Which type of capital fits your specific stage and need? Are you already ready to approach funders? What do you need to be in shape and form to speak to investors? How should you raise, and what is valuations like to navigate around? I mean, this is such a loaded question. We'll try and attempt to answer this, but the key thing is it's an art rather than a science. Well, I'll talk to you about that later on. And eventually, everyone complains fundraising is so difficult, they waste their time around it. So how do you navigate a raise? Like, how do you do this process? It's sort of like a full-time process, but without wasting too much of your time. It's about finding the right investors, and that's one of the key aspects of it. So who's in the room today? I'm sure we still have a lot more that's going to chime in, but we had about 78. Right. Can you mute on your side? Because it's going to cause feedback. So we had about 78 unique registrations a lot were you? Half of the room were here to basically say they are raising now or going to be raising in the next 12 months. And there's a lot of you that are also here just to learn, which is great, right? We want to educate as many people as possible what fundraising is. So when it comes to the time you want to, at least you know how to navigate that specific journey. And the key question everyone was basically asking or trying to specifically inquire was the funding fit, like who and how and what's the issues. Like everything was about the readiness of your business to access funding. So that's where we kind of skewed the presentation towards more of those aspects itself. So I hope all your questions are asked, are answered. And if it's not, just type it in the chat and we'll see how we can get to you. All right, fundraising. So it's not like it's one hypermarket you walk into and every single product is under one roof. I wish it was that simple. I wish you could go to your favorite bank if you had one and saying, here's my pitch deck, Mr. Bank, and would you figure out how to fund me? So it doesn't work that way. Everyone that basically allocates capital from even grants that doesn't take equity, banks, angels, VCs, ECFP, private equity, everyone perceives risks very differently. Hence why when you start your fundraising journey or you even start your journey as an entrepreneur, you could map it out, and what you'd see is sort of like we've been calling this fundraising escalator, fundraising ladder, because at various different stages there'll be different offerings for you. So the more you mature, the more you have access to, and you can be a little bit more selective. But of course, the biggest trouble is most of us will basically face at the very beginning. So this is what it basically looks like, right? So on the x-axis, that's basically in terms of the stages of your growth of a company. You start from very much an idea base, a pre-commercial idea. Then eventually you kind of go into the stage that you're validating the business. Could be within the same year. Sometimes it takes longer depending how R&D focus it is. And then you basically start saying, all right, I found something and now I can basically grow on that. Then eventually you want to basically scale beyond that into different territories. And then you come to that part where most of the times companies look like they're plateauing and you're maturing and you find very different stable ways to raise capital or find an exit. Some people find a reboost to basically start the whole process again. But eventually you could see there are different kinds of financing sources available to you as you climb this so-called escalator or ladder. Everyone starts with the triple Fs, as they call it, right? The family, friends, and fools. You'll find someone to just kind of take a chance, and you take a chance on the idea and basically give you that first check, or you might even use your own. And then eventually you want to try and figure out, it's always between these two things, right? It'll be either debt or equity. That's typically the two biggest buckets. Most SMEs, so this call, I know we have a mix of two kinds of entrepreneurs. You've got the very technology-focused ones that call themselves founders, and also you've got the SME owners that call themselves entrepreneurs. Eventually, you're all amazing people that has an idea, and you're trying to basically execute your vision. But most of typical traditional companies, they only know how to get towards debt, and they stay on debt for the longest time. Eventually, the only time they switch over to equity would be when they go an IPO. So this is why we do talks like this on a large scale to mainly tell people that there is a lot more in between IPO and debt. And this is where you see things like this green areas here, the alternative financing for equity investments, where there's angels, there's ECF, there's venture capital, there's even new things like IEO, the initial exchange offerings, sort of like an ICO, but with tokenized aspects of coins, crypto coins, or your own coins. And then eventually for debt, also there's alternative stuff, things like P2P, before you head on to private equity and then an IPO. So there's so much in between. And today I want to try and speak as much as possible about all these different instruments, including going to some of the new ways to raise capitals from angels and VCs using instruments like safes. So there's a lot to cover, but I don't want to go too deep also and scare you. The idea today is, as much as possible that breadth and slight depth, so you are aware of such tools in the market and you know what makes sense for you, because that's the key thing, right? Capital fit. Know what you need at what point of time and who's the right people to speak to within that category, so you don't waste their time and you don't waste your time. All right. The other thing to kind of get out of the way before we kind of kick into the full content is this terminologies. So these are typical terminologies you see startups use more than traditional SMEs. So if you are an SME and you're trying to raise capital, you wouldn't really refer to it that I'm starting up, therefore I need seed capital. I'm now scaling, I refer to Series A. They kind of just label you there as growth or pre-IPO or mezzanine. So they use very different words for traditional businesses. And startups with VCs has this terminologies a little bit more. But don't be so focused on the actual name of the round. We want to speak more about the milestones, because there's milestones as you progress to scale your business. That's going to be a bit more universal among all kinds of businesses. So when you first start the business, or rather, not even the business yet, you have an idea, we call that category of companies pre-seed. That means what you have is possibly a problem that's real. You have the right founders behind that problem. Of course, we always want to look at the founder at that point of time when it's so early and there's nothing else to benchmark in. And the typical raise for pre-seed, because it's risky, will not be a check that's too big. Again, it's case to case based on the trend of the solution, the location you're fundraising, the particular climate and year we're in, whether there's money flowing or not. Typically, pre-seed starts at 150,000 ringgit check, goes up to 500,000, sometimes even $1 million. So basically, that's the whole idea, right? You get this first check, and then the whole idea of that is to help you build a prototype, validate that idea to say that solution is what's needed, and you get towards that first pilot in terms of trying a POC with a customer. And when that's basically done, you go like, see, this problem is real. I have an approach of that solution that basically works. And now I need to basically scale this. So this is when you get into the next part where we call this a seed round. The seed round is where you've proven that people are willing to pay for your solution. That means the problem is real. The template of that solution is also basically right. So then you need to develop that product a little bit more. And this is where you look at check sizes between $1 million to 5 million ringgit. Typically, internationally, we call this like $1 million US. And you get to build the product a little bit more. You basically get to maybe hire a couple more people that you didn't have in the team, and then you can take this to market. So from a number perspective, although don't quote me on this, how people kind of perceive whether a company is within seed is to see what is the actual amount of traction you have. And traction here could be mostly in dollars and cents. Typically, if you're doing about 100 to 200 to 300,000 US, bordering close to $1 million ringgit, this becomes a very good defined seed that you can raise a solid amount. But sometimes you also find that, someone that didn't even have much, because it's a very complicated process to kind of convert someone to be a paying customer, especially if it's an enterprise solution, that traction revenue can be a little more lesser. So that's why I'm saying that there's no science behind this. It's more of an art towards it. And then to prove that the seed is done and you basically have something that can basically scale even further, and it's basically a business that's repeatable, then you have to basically show, right, the rate of customers coming back and using your solutions, how long they basically lock in. You start into what we call the series round. And typically also the magical number most people look at is the business already doing about $1 million US in recurring revenue, annual recurring revenue. So that breaks it down to doing about 100,000 US a month. So you're talking about in ringgit sense, 45 million shows that you're Series A. But again, we've got companies that are doing way more than that and still can't basically raise a Series A because people would think your market's too small within Malaysia, and they expect you to see you're also branching towards a regional footprint for Series A to basically work. So there's so many variables at play in terms of how big can the product basically be, how big can the market basically get to justify whether can this scale beyond your shores and be a Series A based company. And then the alphabet keeps increasing, right? As you try and build new products, go into new markets, it goes to A, B, and C. Once you hit C, this is where it gets towards the turf of saying you're trying to be a little bit more profitable, you're trying to be ready for an IPO, You have the ability to grow your business a little bit more inorganically. And that basically means the fund sizes are really big, and you can think about using that capital to acquire other companies. So if you want to grow to Indonesia, you want to grow to Singapore or Thailand or Vietnam, but you're doing fintech, and it's so difficult fintech to go into other markets because it's like starting from zero again, because you need regulatory access, you need licenses. So what happens is, if you had enough capital, you could just buy somebody else that's smaller, that might be struggling, but you bring in the business model and know-how to basically acquire them and then hit the ground running. So this is where some of our bigger funds, which is labeled as GLICs, I'll speak about them later too, whereas your Kazanas, your QOPs, your EPFs, these people, when they do direct investments, it's really big checks. They come towards things like Series C, even folks like Petronas, right, from their corporate venture capital arm, they do Series Bs and Cs, the big checks where it's talking about scaling, regional access, and maybe things like M&A activities. This is stuff that they understand quite well. So that's basically the terminology. As an SME, you'd basically say you start on your own, you basically find a couple of angels. That's kind of seed-like. The business is basically doing well. You can make more than R1 million. And then most of you will basically go to debt options. So you qualify from a bank. But if you're trying to now get towards an entity that invests in you, typically for SMEs, they always know more on private equity. And private equity checks in Malaysia is really big. Minimum might be 20 to 40 million. So you'd have to do really big things to basically get access to it. If not in between, that's always been the gap for SMEs to say, like, beyond a bank, who would you go to? And therefore, today you have things like crowdfunding that basically addresses that biggest gap for traditional non-technology companies to basically fundraise. So that's basically the opening gamut in terms of why we're here, what is fundraising about, what does that landscape look like. And the next parts, I want to kind of go deeper into all these different classes of products for you to figure out, right, do you first need this kind of capital? And if you do need it, how do you match yourself towards which capital makes the most sense? And then how do you prepare yourself for this capital? What proof, what evidence is basically needed? And then eventually the structure, how would I basically know how much do I need? How do I know how much do I exchange for if it's equity? What that perceived valuation might be for myself? And then eventually certain terms. But I won't go into specific clauses in term sheets. I think for that, we'll definitely need another talk. And then eventually coming to the raise process. How do you run this as a process, and who would basically be in charge of something like that? So that's basically what we want to basically do. And we'll start with the first part, which is the need. I mean, you don't just start by saying, I need $1 million. I mean, that happens a lot. People just come onto our sessions. So we have this thing called Pitch Tuesday. Pitch Tuesday is pretty much Pitch Tuesday, Wednesday, Thursday, because there's so many people that are pitching us on a weekly basis. And they will just say that they need $1 million. And then you have to kind of sometimes pry it out of them, like, what is the million for? How do you know it's R1 million you basically need, or $1 million you basically need? What do you want to basically do with it? So you basically always have to start with, what do you want to do? Start by at least having foresight of access to be able to know what the next milestone is. I mean, that's the key thing, right? Once you know what the next milestone is, you know how long it takes to get there, what there basically means, then you know how much money basically needed to get you there. So capital, I wouldn't say it makes a business amazing. It's not because you have money, the business is a good business. The funding accelerates a great business. So you have to have a great problem, a great approach first, and then money accelerates that. If you didn't basically have a great foundation, then the money is just going to accelerate your doom, right? It's just basically not going to get you anywhere. It does have the ability to buy you access to a valuable milestone, but in this case, what I mean is you might have to pay to play in certain areas. You're doing enterprise sales to put you in front of the right audience. You might have to access a kind of trade show, and that could be expensive. You may need key people to basically be, because you're tech and you don't have the entrepreneur or the sales team or the ability to know how to do enterprise channel sales. So the funding gives you the ability to say, "Ooh, I can hire my first salesperson, my better marketing person, my better this, my better that." So it gives you that access to certain milestones for sure. But again, that would only make sense for someone who already knew where they were basically hitting. And it has to basically always create more value than it costs. Like I was mentoring some students that were back from a summer break and they're doing this pitch competition, right? So they're showing me how they were doing a model where they received 500,000 in terms of funding, and after 5 years, the revenue was 560,000. So that's where, I mean, they were students, okay, maybe they don't know any better. It's part of the learning process. But we see this in real life too, right? It's like, if I give you funding, you would make more money keeping the money into a fixed deposit. And at the end of 3 years, that money would have grown more than the revenue you basically made. So that's basically not funding well spent. It has to create more value than the actual cost. People want to see, I give you 100,000 and you build $1 million business with it. I give you 500,000 and you get 4x the business from that. That can't be shown, then there's some fundamental issues there. You could argue certain companies are harder to create revenues from. Maybe they're more R&D, more deep tech. Okay, fine, that's a caveat itself. But the ability to kind of show that the enterprise value of the IP or the things that you basically built still surpasses the money that's coming in, that has to be articulated. So bad capital should be things like, you're saying, oh, but I need to give out the products for free first. I need you to subsidize my customer. They would pay you a ringgit or 2 ringgit for a service, but it costs you 10 ringgit to acquire them. So in the past, we've seen some of those models. I don't think so that's mainstream for everyone else. These were the likes of the bigger funds like SoftBank that had the whole thesis of, if I gave you enough money to kind of seed the market with your particular customers, then you'd crowd out everyone, and then eventually you can figure out how to get into a more cash flow positive scene. But that's not for the faint-hearted. That's not for everyone. That's for things that could scale into bigger markets. It's very B2C rather than B2B. So that kind of attempts would kind of hide weak economics. People could basically see that you're not revenue generating. You just have a lot of capital. It doesn't mean the business is basically doing well. And also with certain kind of funds, it might come with other connotations. So that's where some people are always worried about, oh, I'm going to give away equity, I'm going to dilute myself. I mean, that's just one aspect of it. But there could be other obligations that you might not be able to carry out in terms of what were you promising to deliver with the specific funds, the kind of returns, maybe profit guarantees, you become guarantor to the debts. So you got to be careful how certain instruments could be detrimental beyond just saying diluting you. There could be other strings attached to it. So the key is, name that milestone before you name the basic amount. You should be able to tell us like, I need funding because I want to build an MVP. I need funding because I need a certain certification. I'm trying to do something in security, but everyone insists that my solution has, ISO 27001 to show that I know how to handle this kind of environments, this kind of data, and it's a secure environment. I need that product to be certified. I need the product to be pen tested, and that's going to set you back 20, 30,000 ringgit. So that has to be the milestone if you're trying to build something. If you're saying, I already have a product and I want to take it to market, then what is that milestone from a selling perspective? It's about customer acquisitions. Can you tell us how many customers you want to acquire? You want X dollar to get 150 customers, 300 customers, 1,000 customers? You need to be very specific. Market entry into which market, why that specific markets. So every specific milestone, including an SME that says, I need capital for CAPEX. I need to kind of industrialize the business to bring in things like robotic automations, machine learning, quality inspections through AI vision cameras. I need to basically acquire someone else, going to a new territory. All this stuff needs to be defined in terms of why you need capital first, right? The more credible it basically sounds, then of course, then people will peg that dollar amount, that ringgit amount towards what is that milestone and what value that can be created because of that milestone itself, right? Value, right? So the idea is I give you $1, you can acquire another customer. The value of your company now is $1 more than it was previously before I came in. So that's basic math that they basically want to see. So here's an example to kind of depict what I just talked about. If you are a more traditional business and you want to expand a branch, whether it's a restaurant or any brick and mortar, you want to have a second branch, and you may need $500,000 to open that new branch of a coffee shop. There are many ways to do it, right? One is you could say, I want to use my own money because it's too young, I can't get debt. I don't want to allow other partners to come in and tell me how to run my business. That's typically the biggest reason we see. And you decide to say, I want to self-fund it. And the only way you can self-fund it if you take your time. You'd say, I make profits every month, every year. Now, if I accumulate that, after 3 years, I would be able to safely save up an additional 500,000, of course, for other purposes too. But I could carve out 500,000 from those profits to open my branch. So success. You don't have any financing costs. You lowered all that stuff. But 2 years or 3 years for you to get towards that point, there's so much opportunity that you may have lost versus somebody else who says, fine, I'm going to go on to maybe some angel platforms. I'm going to go do a crowdfunding campaign and I'm going to get 500,000 from someone and open it immediately. And imagine this branch, it contributes some significant portion. Maybe annually you have another 300,000-400,000 from it. And across 3 years of compared to waiting for it and just starting it now, you would have gained over $1 million across that 3 revenues. So then that opportunity of that funds could have paid back that principal, could have been written back to the investors, or basically given them confidence to say, scale the business even more. But on your first attempt of waiting 2 years to open that branch, you would now have to figure out how to run the business, be profitable, show in the next 3 years, and then be able to scale again. So the whole idea is that there's no wrong or right. No one says that this has to be the way. You have to always raise money. But you need to figure out how to ask yourself the right questions to make that decision. Like, how do you even know that you needed a second branch? Was there demand that was basically, evidence to you? So if the demand is proven, then fine, go ahead and open it and you can justify it to people. But if you're just taking a gut feel, then maybe it would be difficult for angels to invest in you. So you have to make sure that, does this eventually even make money? Because if this 500,000 you borrowed or you get as equity didn't basically make 375,000 a year, then what does that dilution mean? But in this case, if it did well, that dilution is fine because the business is now worth more with 2 branches doing well rather than 1 branch. So eventually you also have to ask yourself the hard questions. What if there's the downside towards this? What if this became non-profitable? How long can you carry this? Would profits from the first branch allow you to kind of take a while to get branch number 2 up and going and basically getting into the black? So this is where cash flow, unit economics, all these things is very important towards an entrepreneur. You need to keep your eye on this. And this is stuff that you articulate well to your investors so that there is trust and there's belief in terms of this business. Give it another 6 to a month or a year, it will basically be able to return to the black. And today's climate of fundraising, although everyone says there's still a lot of money, and there is a lot of money, the money is a little bit more patient in terms of finding its target to invest into. Hence why even most of our fintechs are all trying to show that this startup, this fintech, it is profitable, or rather it can be in the black, it's not too much in the red. And then it gets VCs today feeling a little bit more calmer when they look at these products and they're saying, now I want to invest. So there's a strange shift that's happened in the market. Venture capital firms are behaving more as private equity firms rather than taking that risk capital as they talk about. But it's what the market is. It's not just here. Even Singapore, we see something similar. So that is something you really have to think about as you navigate this journey. So end of the day, like I said, it falls into a couple of buckets. There's always debt and equity. You could say there's also the first kind of camp of non-dilutive access, where you keep ownership, you get funding. And that's nice in this country. We have got a lot of good grants. There's grants in high-tech R&D. Like the other day, I was speaking to the founder of Skychip, became one of the biggest semicon listed cos in this country. And the only reason why he basically got where he was he needed the right engineers. So he recruited about 30 engineers, and he told all his engineers, show me your EA forms, and I'll give you back that exact salary that you basically had before. So he averagely paid everyone about $500,000 a year for their jobs and to have that cushion of knowing I have a safety net and I know my yearly salary will not be disrupted. And he could get that 30 people coming in to build what Skychip is today. But the reason also he got access to do that was he got a right kind of grant, although it was slightly a reimbursable grant too, but he got about 12 to 15 million initially to make that particular milestone capable. So that basically has its kind of hand in terms of helping a lot of R&D based companies here. You got the likes of Cradle that has the first 150,000 to get an idea up, kind of non-dilutive, although they have some form of clauses where they could claw it back, or they could basically choose to convert to equity. And we've seen a couple of those things happen these days. So you got to keep your eye on that. And also nice, there's always this accelerated competition. So just competitions at large in Malaysia. You see a lot of people, if they're good, they would always apply for this and they always win it. And that becomes a good revenue, I wouldn't say revenue, but a good income for the business to kind of stay afloat. So that's nice to keep your eye on it, but don't make it too distractive that you're changing your way of work, you're changing your milestones just to suit the grant. If the grant kind of slows you down saying, oh, you can't take my grant if you already have a product, and you deliberately slow down product development just to get the grant, or you deliberately build another product that wasn't even intended just to get the grant. So that is not ways you spend your time well, I would basically advise you. And then typically there's debt. You keep ownership, and this is where you go to banks, you go to certain agencies that's financing and P2P and all these refactoring companies that take your invoices and they pay you up front and they keep some change, like a 20-30% change sometimes. But it's things that helps you, operate the business. And then the third pillar is, of course, equity. This is where you share ownership. This is where more traditional businesses find it harder to do this versus technology companies who think first cut, it's always about equity. And you have the likes of Angels and ECF and so on and so forth. So there is dilution that will happen in terms of you giving a stake of the business to someone and you having a lesser stake. But also with that comes in different responsibilities of how you handle money, how do you govern the business, how do you basically have protocols, and eventually how you get them their money back. They want to know what the exit is for them or the exit for the company at large. All right, so eventually when you get different sorts of funds, there is a different price. The price basically changes according to the forms. Like for grants, most people complain like this takes a very long time to jump through hoops to get it. So it's about your time. The price you're paying is your time. You could have been doing something else, but here you're just doing paperwork. So is that worth your time? And even when you get certain grants, there's a lot of restrictions around what you could spend. You could only spend on the technology person. You can't spend it on marketing because it's product development. Although rule number one about building products is selling on day one. But if you wanted to spend on that, would that qualify? Those are things you basically have to figure out. It could be very milestone basis, but it's very hard sometimes to put milestones on something a little bit more engineering focused like deep tech. Like you only know that I am researching to get towards a certain output to prove that this process works, this algorithm works. When does that happen? How do you time box something that you don't know what you don't know? So it gets a bit troublesome to basically articulate some of these things. And most of the grants these days also become reimbursement based because it has been kind of been abused in the past. So that means they might say, you spend your money first, then put in the claims, and then we'll basically pay it back. How fast they do it, sometimes it's fast, sometimes it's sufficient, sometimes it's really long. And sometimes when you need cash flow, that's going to be difficult if you can't make payments, statutory payments, salaries. It just demoralizes everyone. So think about that in terms of the price when you talk about non-dilutive access. When it comes to debt, it has to again fall back on cash flow in terms of can you serve debt? Can you ensure that your cash flow allows you to always be able to pay monthly repayments? Because if you're doing a traditional business and you have clients, that's great, but your customers might be paying you every 60, 90 days, but you have to pay salaries every 30 days. So then you take this specific loans, just make sure the loans is not just short-term gap measure to make salaries for the first 6 months. And then after that, you're stuck again. So you got to think about that aspect. What kind of collaterals do you have? If there's no collaterals, then normally the interest rates are even more higher. How do you put yourself as a guarantor towards this? What if you really stretch thin on other things that you're guarantors on? So lots to think about when you do that. And then in terms of equity, usually it's about the ownership, right? Now, what is the rights of the other person coming in? How much do I have to basically set expectations in terms of spending the money? I know most term sheets would always have something in the section called reserve matters, and they'll say that if you are spending above a certain threshold, you need to seek permission first. You can't just bluntly spend the money any way you want it. You have to seek approvals, and a lot of things they will say, but this is planned, right? You don't just ad hoc spend money. So you would have already a plan in terms of how much you need by when, and you should follow that. So if you're a well-run oil machine, fine. But most startups a little bit more ad hoc sometimes. So you got to be careful in terms of what does those term sheets basically say. And that's the reason why some people don't go into price rounds with venture capital so fast. They work with angels and safes beginning. If you don't know what that means, I'll come to that topic after this. And the last one is, of course, the more strategic kind of investors. These are people that might be, strategic in nature in terms of a corporate venture capital coming in, or larger private equity basically coming in. Then they have very different things that they basically want in terms of control. If it's a corporate that is investing in you from a strategic perspective, not financial, then there could be some exclusivity in it. So we see this kind of turf war sometimes between the oil and gas sector. You might get one oil and gas company in it, backing you, but then it kind of crowds you out to say that if you're trying to get to the infrastructure of the other oil and gas companies, they might not like it that the other one's on the table already. Although they will say, no, it's fine, we play with everyone, but we do see sometimes it affects a lot when you have exclusive terms for a certain industry and you're trying to break into its peers or its competitors. So you always have to be careful in terms of the conflict. But sometimes it's great, you could leverage on certain commercial aspects, but most of the times it could be conflict. So just be careful of that. So before coming to the end of the first section, I mean, to kind of see that, do you already know what your milestones are? Do you know what you need money for? You should be able to kind of write this 4 sentences down. Like the next milestone that will materially change your company is what? Is basically building the product or getting the product to market, to the first 100 customers. How specific can you articulate that? And when you know that milestone, then you kind of know how much do you need. You need 100,000, you need 50,000. So of course, you don't pull the numbers from the top of your head. It will be kind of benched towards, you need this money because it allows you to hire a marketing person and you want to do organic rollouts to basically get the first 100 customers. So it's more of acquiring the person to figure out how to get 150. Or if you already know what's the cost of acquiring a customer, then you need, cost of acquiring a customer is 10 ringgit, you need 150 times 10 is how much you need, because that's the experiment done before, and you know you can acquire customers at that specific rates. So can you be as specific as that? And then kind of, of course, this is not for everyone, but it's always nice to know whether is the business already doing well. For pre-seed companies, of course, number 3 is going to be no, because you only can pay 0 per month. But for a business that's a bit more traditional, you could say, I have existing customers, so I am safe to say I can make certain monthly payments, but how much is that kind of amount that is not a financial burden from you? So eventually today, when we talk about fundraising for the larger companies, for the SMEs, we talk about what we call a capital stack. If you need 5 million, you need 10 million. I wouldn't say get the entire 5 or 10 million from one source, which is equity. We'll break it down, right? Like how much could you use from your specific earnings itself? How much of that could be debt? And then what kind of debt would you have? Because you could safely say, I could pay 5 to 10,000 a month and be okay with that. Then what does that translate to in terms of a loan that you could basically get? And then the balance, let's do it as equity. So you kind of split that across various different products. And that basically makes more sense. And then the final question is, are you willing to dilute the business or not? If you are, how much of control are you willing to share out? Typically, if your milestones are done well enough, of course, it's very hard to say what well enough is. As in, you had the milestone for seed, you had a milestone for Series A, and you can ensure you have one check at each round. Then typically, the safe dilution point will be no more than 20% per round. But again, we've seen companies struggle on seed, takes 8 years to get from seed to Series A. There's no way one check's basically going to help. So imagine if each round you're doing 20%, you do 3 rounds of seed, there's not much equity basically left. So how much is enough? How many co-founders did you have? Did you start like a boy band? You had 15 people, and therefore everyone has equal amount of equity, which means there's nothing left in the company to kind of give out to other people. So these are the stuff you have to think about. I don't think so. We'll spend time in terms of saying, hey, tell me this over the call, but take time later on in the day to kind of write these things out. Like how far of these questions you could basically answer on your own. So that's the first part itself in terms of knowing the specific needs. I'll pause here right now and basically just see whether is there any specific questions? Wow, I didn't expect this to be 45 minutes in already. But is there any specific questions anybody you have? Turn on the mic and ask if you want, or drop it in the chat. Hi, you have a question?
Hi, Bikesh. Yes, I do.
Go ahead.
So is it, thanks for going through this, by the way. It's been really informative. But is it necessary for, let's say, someone who's just registered their business on SSM, is it necessary for them to move to like a Sendian Berhad to get funding or to get investors?
Yeah, so good question. So typically, most equity investments lives or prefers Sendian Berhad. Sole proprietor, no way. Even crowdfunding, you can't work with sole proprietor because there's no concept of basically shares in that. LLP, you could, but a lot of people don't like working with that structure. It is still kind of new. Certain things work, certain things doesn't work. A lot of organizations don't know the do's and don'ts around it. And because people still want to see a company kind of have that fiduciary duty, they want to see audits, they want to see compliance, and typically that's around more of the Sendian Berhad, the capital market, the Companies Act on Sendian Berhad, rather than LLP that has a lot of leeway in terms of governance. So that's why you'll see most of it always wants Sendian Berhad. So if you're starting out as, a sole prop, get the kinks out of the way. Once you know that you have the right product, right thing in place, then it makes sense to convert if you're going to fundraise and have external people in. If not, you'll still be able to get debt financing on some of these structures, but equity will be the hardest.
Thanks. Thank you.
Cool. Right. Maybe a time for one more question, if there is. So that's entirely up to you. So Owenson basically asks, what type of shares are we diluting? Pref shares or ordinary shares? So typically, ordinary shares are, I would say, the most expensive, the one that has most rights, but it's also the lowest class of shares. So investors coming in typically likes preferential shares as funds, as investors that want to get their money back by a certain timeline. Ordinary shares is only when they know you're basically going to IPO and they want to be on the upside. So some people basically has a combination of both. And you see this a lot more on equity crowdfunding because people have never heard of your business. So they go like, why would I have ordinary shares in a business that I don't know about? So to kind of get them in, they give them what we call downside protection. So downside protection is basically trying to say that I will take this investment sort of like a loan, but not a loan. So they do it as a pref share with a coupon rate to say, I will pay you back X percentage on the loan on an annual basis. So this might be better than debt because debt will say you got to pay every month. But from a RPS structure, I could say for this preference shares, I will pay you every year at the end of the year. Or some people might say, I give you the end of the tenure. So the tenure is 3 years or 5 years. So at the end of that 7% dividend times 5, you only get it at the very end. So it gives you that breathing room to kind of use the capital, grow the business, and then basically pay someone out and maybe buy them back out. But as the business does well, people could have more confidence in the business, saying like, wow, you actually built what you said you're going to build, and now you are worth way more than I was before. So this is where certain people then want to say, I don't want pref shares anymore. I want to be ordinary shares because the value of the company is so much more better. And if you're going to IPO, I want to be part of that journey. So that's where certain investments or certain fundraising will do RCPS, where the C is where you can convert And there'll be a formula to convert preferential shares to ordinary shares and saying, now you write the upside. But of course, if you're converting for that, then you can forego the dividends, right? So it's about playing on how those classes of shares help you as an entrepreneur to raise capital, to reduce the risk and gain confidence. So that's typically how it is. But most investment funds from seed onwards will always take pref shares because pref shares is also the class of shares that's higher. That means if anything happens, you have to pay the pref shareholders first before you pay yourself. So if things go well and you exit the companies, the pref shareholders gets their specific amounts first. So this is where, again, when you say you get diluted, it's more than that. It's in the clauses that might say what is the rights of the pref shareholders in terms of their returns. Some of them could have a guarantee that they're going to 2x their money. So if the exit wasn't big enough and everyone has to 2x their liquidity preferences, they end up getting all the money. And then when the balance is gone to the ordinary shareholders, which is you and your co-founder, that's absolutely nothing left. So these are the stuff that you have to really think about. And therefore, you always need a lawyer presence for some of these term sheet discussions. Or usually they might walk you through it with a lawyer. But if you seriously feel like you're not sure what some of these terms mean, you need to get representation yourself. And there's a lot of great lawyers that are more founder friendly these days. So go ahead and try and find one. I don't know if you have one in the call. Is one, I saw you register. If he's here, he is definitely someone you want to basically speak to. I'm not saying that he's good rates. I'm saying he's founder friendly and he has to basically still charge based on the complexities of your requirements. All right, so let's move on. There's certain questions there, and I think I'll get Max to jump in on that because I didn't expect this to be already 1 hour in and we've got so much to go. Let's go. All right, so point number 2, now it's about matching the money, like which instrument you basically use. So this is quite bulk of the topic too. So there are many routes. Your job is, of course, to figure out what is suiting your stage, your risk. So let's talk about that. So we saw there were many ways from that funding escalator just now for you to raise capital, right? It could be, founders funds, family funds. So you're bootstrapping, you're using your own money. These days, we also see some of the high-tech sectors, if you're working on something really niche like semicon, and there is a customer that really wants what you're doing, they're willing to pay. It's quite interesting, right? So they are basically giving you the money ahead of schedule to say, here's the money, build it faster so I can basically use that. And of course, you have the kind of Kickstarter-like models too, where you could say, do pre-sales. You need money for the product. People believe you can build that product and people prepay you for the product and eventually you then figure out how to get it to them in the quickest means possible. So that's basically there. And then we spoke about the non-dilutive ways itself. There's grants, there's debt, there's equity, and there's strategic. So let's go and figure out some of these specific things. So as you grow your business across that funding, or rather that life cycle of a company, you grow from an idea to an MVP, you have a business that has traction, it's repeatable, it's very Series A, and then you can scale. You get different kind of instruments you can use across this funding landscape. The more mature you are, the more instruments you basically get access because there's more proof, there's less risk, therefore more people trust to give you money. It's the early stages that always struggles the most. So one interesting thing to look at from a local perspective is the alternative financing schemes. It is quite a mature market now. I think it's been more than 10 years this has been in the market. So for ECF, it's close to $1 billion already has been raised at the end of last year from its inception. So that's not too bad. Of course, the huge numbers come alternative from a lending perspective, from P2P. So P2P here, since its inception, has done over 11 billion ringgit of debt-like products, invoice factoring, working capital, small amounts in terms of getting SMEs mostly to basically operate real well. So 11 billion has been deployed. And we look at venture capital and private equity last year, about 2.8 billion was deployed into about 117 companies. We'll speak about what that number is also, like who did it basically go through. So for different kind of scale, the different kinds of needs, the different kind of instruments, even on the alternative side. But it was always meant to fund the gap of younger, earlier companies that didn't have the maturity to go to a VC or a bank Then alternative is where the riskier products was. And you can see it's still doable. There are companies that are raising capital from this means. So if you talk about, let's say, the first one, grants, I spoke about this before in terms of a cradle example. It's best for things like R&D, product development, early stages. You might not have a sense of urgency in terms of building it. Then grants are always like a bonus. If you could have an angel check and then a grant, so the angel check can basically allow you to spend the money first, and the grants, most of these grants are reimbursement back, so you'll have cash flow to basically operate, then it's basically great. Or if commercialization is something a bit more difficult, or market access, and you already have a product, and getting a grant that's giving you about 600,000 to put it into the market, do POCs, test it out, that's basically godsend sometimes, to basically allow you to not spend your own money to figure out how to take this to market. But if speed is the key factor, a sense of urgency is the key factor, then that's basically going to be quite difficult then. So there are grants that are very sector specific. There are grants based on your gender. Leverage it if you can, if it's basically non-dilutive. But just watch out for there'll be a lot of eligibility clauses. The reimbursement stuff, just be careful. Make sure cash flow is fine. And what is the restricted use of funds? So you might be going in thinking you have free reins to use it for marketing, but they might box it up in terms of ways you could spend it on marketing first. So just be careful of that. So buyer beware. So that's on grants. So debt is of course great for companies that has repayment very visible. So you're already making money, you don't want to dilute yourself, and you're willing to pay X thousand a month, then it's great. You could find a debt product that basically can match what you basically want to do. And this is saying, I'm funding customer purchase orders, invoices. I have inventory, and I know my inventories are very predictable in terms of them turning over and converting to cash. So then I don't mind saying, spend money to get debt, to get inventory, because eventually the more I have, the more I basically make. Equipment, I mean, that's two ways to look at it. So some equipment you could say, look, that could be debt. If it's debt, it's predictable in terms of the payment. You know that with this equipment, it increases my capacity and I know how to sell, and if I make money, I don't mind putting it into debt. But if you're buying high-tech equipment to do R&D and you don't know when the money is basically going to come in from product sales of it, then this is where you might want to think about equitizing those aspects. So again, it all depends on the business, the milestones, the sector you're in. There's no one size fits all. And of course, that's great for anyone with stable operating cash flow. It's weak when you haven't got product market fit yet. In fact, you won't get debt from any major institution unless you found some creative ways to get debt. So then be careful, right? If there's a long process of R&D before revenue comes in, that's not the best thing. If there's a lot of losses in the business and you can't see the path for repayment, then this is going to haunt you, especially if you're a personal guarantor on some of this debt. So you want to make sure that the valuation of the company doesn't detriment your fundraising. What we saw was a lot of companies like to start with such a high valuation, and then when you get to the next round, you can't justify the valuation in the last round. So nobody wants to write you a check and invest in you unless you take a down round. So then what happens is the founders have to figure out how to get some kind of money. And this is where they take these loans. They figure out creatively, or some particular venture debt financing out there might give you a loan if the business is kind of sound, but just you need to figure out how to get out of that valuation trap that you put yourself in. That means you need more revenue to prove this is what you're worth if you don't want to do a down round and dilute yourself even more. So then you take on debt to basically work so hard to come out of that trap and set back the proper valuation you should be now at and fundraise. So these are all the expectations that's out there, right? When you kind of always think about valuation and fundraising at a rite of passage, it's like a trophy. I want to have, the biggest valuation, a press release on TechCrunch or E27 or Digital News Asia to say that so-and-so raised money at this valuation. You're so proud of that, but it's just going to kill you 6 months down the road when you can't, fit into the shoes that you built for yourself. All right. So P2P works faster than the bank, but it's still debt. So just last year in 2025, 2 billion was deployed. That's insane. You can see the bulk of the campaigns were 50,000 and below. So these are people that's turning around working capital, short term, 3 months long kind of stuff. So it becomes like a well-oiled machine, and these people will fund many different notes from one company 3, 4 times a year sometimes. So when you do P2P, you have a target amount that you want to raise. You have to achieve at least 80% of the amount you wanted to raise. Saying you have an invoice for 1 million, or make it even smaller. You have an invoice for 100,000. You need to at least get 80,000 funded in terms of the invoice from the crowd for you to keep the money. If you don't get 80% of it, everything's basically returned. But if more people want to, and your invoice was only 100,000, you can't go above it too. So it can never go above the initial target. For ECF, it's called the green shoe. You can go above if you want to dilute further, but for P2P, you can't. So you use this, of course, when cash conversion is very visible. That means you have inventory, you have product, and you know that customers are going to pay, and it becomes money as clockwork. So that's basically fine. But if your repayment is iffy, you know the customer's payment cycles are too long, you are dependent on some kind of equity raise later to pay all these things back, then don't dig that hole any deeper. Then there's angels. So angels are pretty cool. Today, you could actually go on LinkedIn and search for angel, and people tag themselves that they are angel investors. And the fact they're on LinkedIn, I hope that means they want to be connected with. So you get to knock on a lot of doors of people that want to take early risk. But of course, angels, when they want to take early risk, that means they want a solid upside. So if you're going to kind of screw them over and set high valuations and give them a small chunk of equity, by them giving you the trust and taking the risk of coming in early, they will walk away. They have enough deals on the table. You need them, they don't need you. The other thing they bring to the table is, of course, great advice, because the fact that they're rich and they can write checks, they've seen the world, they've done business, they can give you great advice and what we call pattern recognition. That means they can tell you, if you do this, this is going to fail. Like, this is not the kind of ways you want to do certain things. They've seen things like this happen before. They have great introductions. Typically, they have access, their network, their Rolodex, as we used to call it back then, of knocking on doors and opening up doors for you because they're all friends somehow. They can introduce you to other investors, later funds, because if they are good angels, they're also investors into other funds. So they look out deals and they send it to the fund's ways. And then it just makes things faster because it's very relationship-led in terms of decision-making there, and their connections could give you access quite fast. So, but they still expect credibility from you as a founder. If you are straight off from fresh and you've got no credibility, then it's the story on who you are, why are you so fresh and you can still do this. They will have to build some credibility around who you are and what you're doing. They have to believe in terms of what your market is going to be, and therefore the insights that you can share with them gives them that aha moment of them saying, oh wow, I never heard of that before, I never thought of things like that before. Pretty interesting how you say certain things. So they want to hear the market insights and they have to believe in those things. They want to see how the money they give you has a path towards value creation. So like I say, I give you 100 grand. Don't tell me that you can't make money with that. What is the milestone and what is the outcome of that to get towards it being worth more than where I am coming in at this point of time? And then the terms have to be very clear with them. You don't kind of just keep it loose and say, I'll figure this out later. My cap table, I haven't sorted it out. I'll put you in later. Man, they are very specific on the hygiene on how you basically handle shareholders and documentations, etc. So just know that the best angel is not the one just because they're going to give you the highest valuation. It's going to be the one that asks you the hardest questions. That means they've done this before, they've seen these things before, and they will know how to guide you if they were in the means of giving you help. Not every angel wants to also be the mentor. And this is where you might come to the point where they will say, my money is my money, but if you want access to my network, they will ask for advisory shares. Then it's on you to basically decide, is that angel worth basically saying they're an official advisor, and they will then give you their entire network too. But usually it will not come as expectations of part of the check. It's two different things for professional angels. Now let's talk about VC. So I think a lot of your questions is around that, right? Like, how do I get money from VC? Why doesn't a VC basically fund me? So VCs don't fund everyone because they can't. They don't have enough money, and they don't fund everyone means even good businesses don't get funded. Let me explain about that. So the key thing with a VC is it's not their money, it's other people's money. So therefore, they have to return the money, and then to return the money more than what they basically took if they want to make some profits out of it. So therefore, when they look at companies, they need companies that can guarantee to some extent, well, I won't say guarantee is the word, but at least be in the running to be able to do well. So that means if you're doing something really niched, then the price point of this niche has to be really good. If not, what they always want to see is large markets beyond Malaysia. Where could it be? What is looking alike like Malaysia, that from Malaysia you can go into a different market in Southeast Asia? Of course, the myth is from Malaysia you can get everywhere and get 700 million people. But we've been doing this for 13 years. We hardly see companies that can scale from one country to another. It is not easy at all. So therefore, the economics have to show that this is scalable. That's where if you have a SaaS-based product, it's online, you could get a global audience from day one, that's fine. But most of our businesses, if you realize here, are very service-oriented, right? So to go somewhere else is always about starting ground up again in other markets. So the growth potential is not as rapid as most of them basically want. If it's something that can also have a great moat in terms of the defensibility, that is not easy for someone to just break into your sector because you've got some deep tech, some IP, some technology know-how the others don't, and is defendable, then fine. Because it's so hard to scale, it gives you time to kind of build that moat and go out, and not somebody else comes into another market and builds a clone of you. So they'll want to then eventually have this exit path, like who's going to buy this? How do we flip this? Because for them, the longest they can hold is the life cycle of a fund, and that's typically 7 years, maximum 9 years. Not everyone has that indefinite hold in terms of saying, 15, 20 years, they can still be on your cap table. So that's why they're very selective and they're very transactional and cold to certain aspect, because hey, it's not you, it's me kind of thing, right? This is my fund, this is my structure. I only can look for companies like this. You don't fit the bill, doesn't mean you're a bad business. It just means structurally you don't fit my shape. So for the sake of arguing, this is their math in their head, right? My fund is 100 million. I need to basically return to my investors the money and more. So typically they'll commit to say that, can they make 3 times the money back? So imagine they have to distribute back 300 million. So 100 million goes back to everyone. The 200 million is where they get to share. So if they're thinking, I need one company, one hit to give me back everything, of course, doesn't happen all the time, but this is the best case, right? One company can do it. I just need 10% ownership in a company that's worth 3 billion to make 300 million. Simple, right? Just go find that 3 billion company. So every time they evaluate you, it's about, can you be 3 billion? So if your market cannot show it can be 3 billion, they're not interested. Of course, this is just kind of the rudimentary building blocks of how VCs work. If they can only focus on one, it's going to be quite scary too. So this math is basically how they hedge it across maybe a few portfolios. So if everyone they're writing, 2 to 5 million checks, then they can write how many checks out of that, how many could be a portion of this. So they're trying to just hedge themselves to find the biggest bets based on that criteria to give them their money back. That's basically what they're doing. So that's for you to then realize not every VC is your VC. This is why you always complain that I had to speak to 100, I had to speak to 200, I got so many rejections. It's because they were not supposed to be for you anyway. I don't know why you're wasting your time knocking on doors of Glicks when you're still pre-seed. Why are you knocking on doors that focus on B2B when you're B2C? You cannot convince them. It's not like you have an amazing pitch. You're going to change a thesis and mandate of a fund just because you have an amazing pitch. Never is going to happen. So you need to know which VC is in which stage, what's pre-seed, what's seed, what's Series A or later. So we have this listing on our resources like mulku.com, and we'll give you the links towards the end. Which ones basically eventually writes the check first? Because there are a lot of VCs that will say the teams are small, the fund is small. They don't want to be what we call the lead investor. So they will say, you find someone else to come in first, do the due diligence and do all that stuff. Prove to us that this is a company worth investing, and then we will tag along with it. And most of the time, if somebody doesn't want to say no to you, and no one wants to do the work, you're always going to hear the thing about saying, let us know when you have a lead investor, because they don't know how to evaluate certain criteria possibly too. So this is something you're going to face a lot when you start knocking on doors and fundraising. So always trying to find out if you're going to, again, with AI today, I'm sure it's just one prompt away, right? Like show me, 5 VCs in this region investing in my sector that was the lead in that investments. And usually in the press releases that's there. So AI should be able to crawl and give you all this information at your fingertips. They go by certain sector, certain sectors they want, certain sectors they don't want. If you're in clean tech, a fintech fund is not going to invest in you just because you ask politely. There's geography. They only will be mandated to Southeast Asia, Malaysia, US. I mean, some that might be global funds, but most of them have territories they basically work on. And then sometimes around ownership to say that, is there a minimum size they basically want? Because again, back to this here, right? If they're expecting to hold significant portion at the point of exit of you being 3 billion, that's going to be what, 8 years down the line if it's high growth and growth enough. Imagine what they had to be starting with in terms of equity for them to be diluted. So of course, it doesn't make sense, right? They can't start with 30%. So this is where then also a lot of the funds will double down on you. If they see you grow, the funds will be, kept aside to say that this is our biggest bet. When you go from seed to Series A, they come in. When you're going to a Series B, they top up. You're going to Series C, they top up, because they want to ensure that a company that's growing on that trajectory, they keep that equity going, because that's going to give them their money back, right? So the other aspect then is to look at the portfolio they have. Like, have they got something already like you? Then it's kind of conflict. You don't want to go pitch them and tell them everything, because chances are they won't invest into conflict, but they learn about you and pass it on to the portfolio. But if there are things that are adjacent to you, saying, oh, wow, I'm doing downstream. This private equity firm has the upstream investments. Now, by us being their investment portfolio, this is more traditional companies, I could get some kind of preference working with the other portfolios, right? So these are ways you want to navigate to figure out then how you build this filter. Always find VCs that are in your stage first. Then, in terms of them ability to write the checks, have they written checks? Do they even have monies to write checks some more? And then only saying, all right, based on this, am I in their sector, in the geo, and ownership will be the last thing, whether they need that much equity stake or not. It doesn't make too much sense for early stage for sure. Then these are the fund managers you basically want to speak to first. So qualify them, do an Excel sheet to basically help you decide these things. All right. So once a VC is interested in the process, it takes one person to say that I kind of like it. And that could be the first person you meet, an analyst or associate. And it's that person's job then to say that if they really like you, they like their idea, they're building the case for it in terms of putting this towards the IC. So same thing, right? So most of you, if you pitch to us, you'll speak to Max that's answering the questions over here. And if Max thinks that's basically interesting, like he'll come to me and Suresh, who are partners in the fund, and saying like, we really need to sit down with this person because they're really interesting. But if you don't pitch to him and don't articulate to him well enough, and he just takes it as transactional in terms of, all right, tell me all the stuff, put it into an Excel sheet. He's not pushing you more than he should because you didn't give him a reason to, then that's going to be detrimental for you. So your job is to be close to that champion and have them have all the insights they want. So when they ask questions, you need to give them the answers because they're making the case for you. Then eventually when it gets to investment committee, they decide. So every fund works differently. Some of them, they kind of know how the ICs work. So they kind of know whether an idea like this would get through or not. They would do more due diligence before they have any idea if this is going to be passed. So this is where, again, some people want to play ball, some people don't want to play ball. Certain founders might say like, look, if the IC doesn't even know about this deal, why do I have to give you so much information? But that could be detrimental. But when you get to the IC board and they ask questions about, hey, do you know this, do you know that? And the analyst or the associate on the case says, I don't know, they weren't sharing that stuff. That could work two ways, right? One, they could say, okay, let's go find out more because we like this deal. Let's go do more better due diligence on this. Or they can say like, wow, these people don't want to share why we're working with them. And then say, move on to the next deal. So this is where you want to really work close with the associates and analysts on deals to basically push you as a case into it. So when VC say no, like I say, it's not a verdict on the business. Like the first four reasons they say no, like it's outside the mandate of the fund, you're too early for the fund, you're too late for the fund, or they're too late for you. The check size is a mismatch. You're not within the kind of structure and geography of where we invest. That's more them than you. And this is a structural issue. So don't take it so bad if they say no. In fact, you should have known that, and you shouldn't be getting no for structural reasons because you wasted your time and their time going to them in the first place. So then it's about the other things, right? That they were the right companies, but there was a conflict in the portfolio, the fund timing that they were basically towards the last couple of checks. And when they are the last couple of checks in terms of the reserves, then they're going to be overly selective of saying, yo, we only got one or two checks to be left. How sure are we in terms of this company? Let's wait it out the end of the year and see if there's more people, because people know fundraising here is too slow. There's no sense of urgency on their side to give you the check now, because what if there's another one that's coming 2 months down the line that's even better than you? So this is then what's going to basically happen, right? Or you just don't have the internal champion that was fighting for you in terms of the fund, or your return profile, your market is too small for them to say that this would be the last bet of few bets we want to take. So the key is you can ask VCs on reasons they rejected you. Just be ready for no reply, because can you imagine we're seeing like 10, 20 companies a day, everyone's bogged down on processes. So they won't have time to curate, especially if sometimes when we send a reply, then you will ask 10 more questions and the analyst will say, see, that's why I don't want to reply. So but the key is if you do get replies and the replies are very common, then look at what they're saying. And if the information is saying your market size is too small, your approach is not novel enough, then it's more you than them, right? That they're giving you a clue that the approach you're having is not appetizing to a VC. Do something that's different, or then just tell yourself VCs are not your route, and figure out if there's another way you could raise or find new ways in terms of a business model for you to survive then. So this is how you're going to just not be disgruntled when you say no. How do you use this as facts to move your business on? All right. So the check from a VC is a very long partnership. Sometimes we always joke like, marriages, you can have divorce, equity investments, you are stuck to death do you part. So you get capital. It's a signal in terms of depending, tier one VC invest in you, great market signal that you're on the right path. That's where people start seeing there's copycats or more people want to invest in you because there's a signal sent to the market that this is an interesting sector and an interesting approach this person has. They introduce you to customers, they introduce you to talent from other portfolios that move around. They teach you about governance. Again, same like angels, pattern recognition. They can tell you what worked for a last portfolio, what didn't work. You get a lot of this advice. And there's potential, but we don't guarantee that's follow-on capital. So on our side, we've invested recently in a company. We wrote about 3 checks across the same year into the same company. It was like close to 1.5 years, just because we saw amazing progress. We say, this could be a really interesting startup. Let's give them more capital and grow our equity ownership in them. So we wrote 3 checks back to back. But they'll expect things like frequent reporting, transparency, monthly cadence in terms of your cash flow, your statements, your plans, your budgets. Sometimes, depending if the check's big enough, there'll be board meetings, and there'll be reserved matters to basically say, every time you do certain things, you got to tell us first in terms of how you spend. They always want to see what were your milestones planned for the quarter, how did you deliver against that. But this is, again, when it becomes bigger checks, they expect this level of scrutiny. If it's still early stage angels, you're doing safes, then maybe it doesn't go to this level of detail. And they always want to know what's the credible next round. What's the milestone you need to get to the next round and closer towards the exit? Because they need to track this as we do our audits in terms of a fund. The auditors will also ask us like, okay, this company, is it worth more or not? How do you basically show that your assets being managed are basically growing to basically make your investors basically happy too? So it can't just be pegged flat forever. So there needs evidence to say that the needle's basically moving. So this is where it's interesting, right? When you look at the last year's audit or rather annual report from Securities Commission, this was the breakdown in terms of VCs spend their money. So you can see more than 50% is spent on bridge and IPO. I'm talking about VCs here, not private equity. So VCs are playing it really safe and going to very late stage companies. In fact, today, if we look at even 500 startups and Gobi, the fund that they're actively managing now is a growth fund, and they're investing in non-technology companies. And I don't think so they have an active seed fund anymore for tech companies right now. Maybe they will get a new one soon. But at the moment, you can see the funds are going towards the bridge rounds, the pre-IPO rounds, the growth sectors. If you look at early stage startup and seed, it's only 17% that's basically being deployed from that. So that's basically pretty small. So this is where alternative is a key thing. And the alternative here for equity is called ECF. This is where it's like a mini IPO. You're turning your community, your value chain, your clients, your customers, your suppliers, your distributors to become shareholders in your business. So the strong cases for ECF is, especially if you're trying to get retail participation, it has to be a business that everyone can understand. So if you're on a B2B side of things, and your enterprise, your traditional SMEs doing things on upstream, a lot of people don't understand that, therefore it's very hard for them to invest into that. So this is where you want to get your community, your partners that understand your business to invest in you and then leverage some of the incentives they have for ECF, which is co-investments. I'll talk about that after this. But the whole thing with this is to prove that the business is viable. The business is basically there to grow. Therefore, you need some evidence that the business has demand and the numbers are credible. So you have a lot of disclosure. You will show things like your audit, your management accounts. If need be, sometimes even a valuation report. They need to have reason why investors wants to advocate you. But ECF is not a shortcut around due diligence. You can say that, oh, but it's not an IPO, therefore, it's simpler to do ECF. I don't have to have governance. I don't have to declare different things. No, it's still a highly regulated process, and we're licensed by SC. So therefore, it goes to quite an amount of scrutiny also when we basically want to decide who we raise for. It doesn't guarantee public demand just because it's on our website and we've got a few thousand people. It still has to sell. It still has to have a good deal for people to want to share and talk about a deal. So people always think when they come to the platform, I'm paying you fees, therefore you're selling for me. So it's not a replacement that you're outsourcing the selling to us. You are still basically going to sell. You're still going to be doing roadshows. You're still going to be knocking on doors. We are mainly a platform for ECF to legitimize the ability for you to sell securities, that means shares of your company, on public. Because if you just went on Facebook or LinkedIn and saying, hey, I'm looking for investors, anyone just wants to invest, give me money and I'll give you shares, you would go to jail. That is deemed illegal. So this platform legitimizes that aspect itself, right? So an ECF, like I said, you have to disclose a lot of things in terms of your audits, your accounts, the shareholders agreements, the term sheets, all these things, expectations of shareholders, the obligations has to be public, just like an IPO. So if you look at the numbers last year, we did about 70% for non-tech companies. So it's not just, people always thought ECF was for startups. It's for everyone that's early stage that basically find it difficult to raise. So we're seeing a lot of non-tech companies, but lately we're also seeing companies that are a little bit more older. That means they are 6 years and above was 40% of the companies that raise. And close to half of those people raising were above 3 million. So there's that shift that's happening also in ECF. When we first started, it was always that 50,000, 500,000, very early pre-seed. Now it's venturing into a Series A side. And when I say Series A, of course, just the classification of saying it's a viable business that wants to scale. And these are non-technology companies that are saying, I can't go to private equity because I only need 3 million. I need 5 million. I don't need 20 million. I don't need 40 million. I don't want to get diluted so much. There's no avenue for that. So this is where equity is for that group of people itself. So this is something viable for you to think about. So at ECF, what the ceiling is 20 million. That means you cannot raise more than 20 million for a campaign in your lifetime. So the maximum you want to raise, 20 million. You can do 5 million this year, end of the year, you do another 5, and the next year you do another 10. You could stagger it across or do it one shot. If you're trying to raise more than 500,000, we always say that you need to show that there's already a year of operations, there's an audit, so that people have some trust in terms of the business. The companies here, when we talk about shareholdings, issuance of shares, it has to be a certain berhad. Although you can also be a berhad, but the berhad has to be unlisted. So just for some reason, you have a berhad structure because you have more than 50 shareholders, but you're not have done an IPO yet, you can still basically raise on this platform. But we won't take sole props for this. In terms of disclosure, I'll talk about some of the documents after this. But the key thing is tell us about the business, tell us about the use of funds, you show us the financials, you show the management accounts, and you want to basically tell us what is the share classes you're giving and what's the rights of investors in this business itself. So there is about 12 to 13 ECF licensed operators. There will be a couple more, but they haven't started. But just make sure if you're trying to crowdfund, you go to the ones that are licensed by SC. So if you're not sure, you can always go to the SC website. You can find out who are the actual licensed platforms that basically do this. Other thing on ECF is because it's a crowd, you could have maybe 10, 20, maybe even a couple of hundred investors. We try and keep it clean on your cap table. So your SSM doesn't have like, so many names. We only have one shareholder on record itself, and that is the nominee. So the nominee, let's say if you're raising with lead capital, it's called lead nominee surrender high. So we have that name on your cap table. It holds the percentage that represents all the other investors. So the nominee becomes the legal holder and the administrator. So therefore, there is a payment for this annually. I'll talk about that later, where we will coordinate notices and updates to all the investors. Rather than you send an email to 100 people, you send it to us, we put it on our platform, and we notify the 100 people on updates. If there are certain things that needs to be signed on, and then we basically get everyone's vote on it, and we basically sign it on behalf of all, as long as the majority says okay. So end of the day, the investors are the beneficial owners, but we keep that registrar on this, and we report this to SC. So if anybody is trying to do background checks, basically we will be able to say who truly owns shares in the company. But this will be minor shareholders, so it's not like the ultimate beneficial owner has a way to make you do certain things. So that's basically fine. So the 3 timelines in terms of an ECF campaign would be the preparation period. I mean, we put it here as maybe a 2-month duration, but it could be longer depending on how much have you got in place to say all the documents and governance is already in play. But clearly, it's about knowing what are the terms of the investments. Have you got a lawyer to think about the term sheets, the shareholders agreements, going through our due diligence and audit, which is mostly background checks on every single shareholder that's registered in the cap table, looking at past year's financials and management accounts, ensuring there's no red flags over there. Then we'll build a campaign and offer before we put it to the public. When it's in the public's eye, it stays there for about 3 months usually, so that's about 90 days for you to secure the investors and basically answer any queries they may have. And if the funds are disseminated and you hit the minimum amount you wanted to raise, then you get to keep all the money. If you don't hit the minimum, we'll return all the money, similar to the P2P. And on closing, we always give them the ability to have a cool-off period of 6 days. That means this is where if they just suddenly feel they want their money back and they don't want to do this, we will return their money. You allot the shares, and then we transfer the proceeds to you. So that's typically what it looks like. It's not something they can say that in a month, I want to basically go live. I want you to do due diligence. I want the money to come in, and I want to basically get the money back in my bank account. It can't be done unless you kind of been discussing with us for a long time. We already know about you. We already done our due diligence. It's just a campaign. You took a time to basically decide when you basically want to start. So key thing for all these things, not just for ECF, but also for investments at large, you need to know how to keep that data room ready. The data room is for a set of documents that are standard around corporate, financial, and about the specific campaign. And if it's a VC world, that's basically your pitch deck, your business plan. For ECF, then there'll be specific things around valuation reports if you're trying to raise more than 5 million or other things that may not be on this list, because this is a non-exhaustive list, depending on the kind of business you're in, the kind of questions or risk profile we think you're in. The documents could be requested further itself, right? But these are typical documents most people want to see. So ECF then, because it's open to the crowd, you need to understand a little bit about what the crowd means. You have category that's called retail. These are anyone who registers and saying, I don't want to declare anything. I'm not going to show you my income. I'm not going to show you my particular assets. I'm therefore deemed as a layperson. I'm a retail investor. People who are deemed retail can invest maximum 10,000 per campaign, 50,000 in a year, 12 months. They can be local, they can be foreign. So if you're basically targeting a fundraise and you're saying my share price is so much, one lot is this many shares, and the lot price is more than 10,000, then you directly lock out retail investors. But some people want this. They just don't want retail. They only want bigger checks, fewer people to handle. So they do this deliberately. But if you're trying to get mass market, you need to ensure that the lot sizes doesn't go above their threshold. And not everyone wants to maximize the 10,000. So you got to basically decide to make lot sizes a little bit more smaller so people could take more than one lot and maximize the 10,000 limit. Angels are people who have income of at least 180,000 ringgit a year and can declare net assets of about 3 million. So they then can invest 500,000 within a year, whether it's in one campaign or multiple campaigns. That's their limits. Sophisticated investors are someone who basically earns over 300,000 annually, or they can basically show that they are professionally qualified to be an investor. They've been investing in capital markets, they're a registered VC, a fund manager, a CFA, they have qualifications that deem they understand investments, then they have no limits. They can invest as often, as much. So the key is these people, angels, sophisticated, usually fund the bulk of the deal, and then the rest is kind of filled in by retail investors. It's always the kind of Pareto 80-20 rule. One thing that's really been amazing from the very beginning with crowdfunding was the government coming as a catalyst. So initially, there was always this co-investment fund, and people keep thinking it's free money. It is not a grant. Whatever your terms are in the campaign, the co-investment fund matches your investment and gets the same terms. So an example, MySIF is the traditional co-investment fund, and whatever that you basically raise, so typically we say you raise 4 ringgit, you get 1 ringgit. The rights of that 1 ringgit is whatever you gave the people that put in that 4 ringgit itself. So initially, when it first started, the fund size was about 290 million. The fund has recycled so many times across P2P and ECF that the co-investments have gone towards over 1 billion. So that became a very successful instrument for SC to prove that coming in, investing with the knowledge of on the intelligence of the crowd is a safe investment for government funds to be parked alongside with this. So based on that now, there's so many new funds that are going to be launched. There's even, I don't know if I should be telling you, but there's going to be a co-investment fund for AI and specifically agriculture. And now in the market right now is the COSIF fund. So the COSIF fund is an initiative by MITI for mostly non-technology companies or super high technology companies that are aligned to the National Industrial Master Plan. So this is where they want to see things like the EV sectors, medical devices, semiconductors, smart manufacturing. There's a whole list on the MITI website in terms of what these sectors are. And they've put aside over 300 million. We've spent about 87 million already. So there's still, 250 million left to be deployed into any company that is deemed within the value chain of these sectors that they want from a manufacturing perspective. So I'll talk further about that. So for myself, if you are just any company, a startup, a boutique, a coffee shop, anything, you'd always fall onto this default general SME matching. That means this is the 1 to 4. For every 4 ringgit you raise, you get 1 ringgit. The ceiling for this is always 1 million across all of these things. So that means if you raise 4 million, the government will invest 1 million in you. You could raise 5 million that way. Pretty nice deal. But if you go into certain sectors that they're trying to push more creators within the field, like food security, environment and social impact, or even the silver economy, where we talk about aged care, child care, health, wellness for that economy, they're doing a 1 to 2 match. That means you raise 2 ringgit, you get one. So if you raise 2 million, they invest a million, right? The ceiling in all this MySIF general ones and some of the specifics is a 1 million ringgit. Now we see co-investment on steroids. That's called COSIF. The matching here is ridiculous because this is for this really huge sectors that need a tremendous amount of money in terms of capex and setup and factory lines, automations in terms of AI, robotics, semiconductor development. The check size goes up to 20 million on the matching. And everything now, they were different before. There was a 1 to 2 match in terms of other sectors, but priority and the new growth sectors, things like advanced materials, EV, renewables, and carbon capture, they do a 1 to 1 match. You raise a million, you get a million. You raise 100,000, you get 100,000. And the ceiling is 20 million. So if you raise 10 million, the government will co-invest 10 million into your campaign. So if you know you already have partners and suppliers and you're going in, venturing into these new areas and you have funds parked for this, the key is you'd want to leverage the ECF and the co-investment model, kind of crowd in that and basically grow your particular nest egg to make the business more successful. The one that was just recently announced, which was really ridiculous, never have seen before, is the 2 to 1 matching. So not 1 to 2, 2 to 1. That means you raise 1 ringgit, you get 2 million ringgit. So can you imagine that? So you raise 10, you get 20, but then of course this is not possible because again, if you're doing ECF, the highest amount you can raise is 20 million. So if you raise 10 and you're supposed to get 20, that's 30, you cannot. So the maximum becomes then 10 to match 10 in ECF. But P2P, so peer-to-peer debt, has no limit. The limit for peer-to-peer has always been the risk profile of the business and the risk threshold of the platform. So if you go to someone bigger like a CapPay or funding societies, and they're willing to say, take a 40 million debt and you're going to raise 20 and get 20, you can do that. But on ECF, the ceiling is 20 million. So this is really amazing. If you are within these sectors, you are trying to build, even if you say ICT. And so the idea was, how do you prove your ICT? So here they look at certain kind of certification. So ICT, if you have an MD status, you're deemed ICT, you can get a 1 to 1 match up to 10 million itself. If you're in food processing, then you basically show, what kind of business registration, what kind of business M&A that you basically have set up in terms of the areas of business that you're in to prove that you're in this, then you can basically fall into that. But certain things might have specific documents that you need, like showing us you have a manufacturing license. But if you're saying I'm only assembling, I'm not manufacturing, then MITI or the MIDA has also the exemption of an ML license, and you have to apply for that. But these are all just stuff you can do online. It doesn't take too long to get these things to basically be deemed qualified for these co-investments itself. So in terms of fees, what does it look like? Typically, this is going to be broad across platforms. There's always an onboarding fee that's fixed and you pay up front that basically does the screening and application process. There might be a due diligence fees, and some of them might put it together with onboarding. Some would itemize this, and this means the background checks they do on all the shareholders, the experience, the CTOS scans, seeing if you're politically exposed, file for bankruptcy, etc. So there's a fixed fee for that. And then there's the success fee. So in terms of the campaign being successful, then you pay this. But the fee, if the campaign is not successful, you didn't hit the minimum threshold, then this is not charged at all. And legally, the rate of charge is between 4 to 8%. So the more you raise, the lower the percentage, and the platforms basically decide. So it's a willing buyer, willing seller thing. There's also the nominee fee that could be an annual fee that they charge starting in the second year, or sometimes they charge you in the first year too, in terms of maintaining that shareholder registrar for you and the communication with the investors itself. So typically these are the fees. It's way more cheaper than, of course, trying to go towards a listed environment. But this is the stepping stone before you become a listed co, because this is the new thing that's also coming. Possibly by year end, this change will be announced public. Now it's a consultation paper. So the idea was, can we get more ECF? Because ECF is really like a Bursa environment, right? You're really taking money from the public. Can we get you now to go the next step in terms of climbing the funding escalator and be a listed co? Again, this is not for everyone, but what they're doing is they're creating a path for anyone that successfully raised at least 5 million via ECF and VC or PE. They must have a ECF component in it, and within 6 months of that fundraise, you can be a listed co. So all of the platforms, which is the what we call RMOs, registered market operators, we can then nominate you and submit you to Bursa without paying for an approved advisor yet, where you then get listed by introduction onto Leap, and you're a listed co. Then the idea is, can you transition within 2 years from Leap to ACE? If you can't, then they delist you. But if you can, then you continue on with the listing fees, appointing the continuing advisor, and basically be the full-fledged ACE listed market company itself. So these are all in the works right now. We are in the consultation paper. It's really a public consultation paper, and we're really looking at pilots and talking to companies that want to basically give this a try. So the route is much more simpler. You have a 5 million threshold to basically be the entry gate. I didn't state it here, but for Leap, there needs to be a 10% spread. What does that mean? It means 10% of your shares has to be held by public. So if in ECF, you already had 10% people holding shares, then it's fine. But if you did a small ECF round, only 5%, 6%, then you'd have to basically raise a little bit more and get the public in when you go basically Leap. And this has to be, so that's the part we're still negotiating and trying to clarify whether it has to be ordinary shares or even preferential shares. By right, you should be able to do pref shares, but we hardly see pref shares in the market. The concern we have is this would be great for traditional businesses, but for startups that have negative earnings, how is this perceived to go into market? It's not impossible, because if you look at the laws of IPOs and Bursa, it says for these early stage access like ACE and below, there's no profit test. So you don't have to be profitable to get into the market. But historically, it's always profitable companies. So this is where we're getting to new turfs, and I think it's really exciting times where we've really leveraged capital markets that can raise literally billions for a business. Even Zeus is now trying to IPO $1 billion, right? So a lot of companies now will get the ability to have access to capital markets and then grow their businesses to become ACE and main boards itself. So that's pretty interesting how that's going to be done. So everything in this is going to be simplified. Instead of having like a 400-page prospectus, all they're doing is a very simplified information memoranda, sort of like a pitch deck, but in Word form. It's not going to be more than 20 pages long. They're allowing retail to participate now into Leap, that you basically capped at 100,000 per issuer, still significant, but you still have your typical ongoing duties as a listed co, right? You need the advisor, you need to do your reporting, there's so much governance you have in place, but it really professionalizes your company. So that's basically it. All right, so I'm going to step on the gas right now. So for later stage companies, then you have things like private equity. So, I mean, PE is not just saying, hey, it's a larger VC. There's much more than they basically do. Because like VCs, they would basically invest into your business. So that's primary money that goes into the company to say, acquire something or grow the company and hire more people, expand into other markets. But they also provide you potential liquidity. That means the fund will buy some of the founder shares. So someone is running really long that says, look, I want to take some chips off the table. I want some money in my pocket and I want a partner to take this further. PE funds basically specialize in that. The PE funds can also come and say, like, let's help restructure the company. You've got so much debt you've taken across the years from banks. Let's use the fund we put in, that 40 million, that 50 million, to pay back all the debts, keep all the interests being served in-house, restructure the business so the cash flow stays more positive, and now think about growth options in the business rather than just, trying to survive. Or sometimes the funds are meant to buy out something or get a management buyout and have the management take over the business because the previous administrators may be too old, don't have second gen, don't want to continue, and they want somebody else to take this over. So the PEs expect these kind of companies to always have positive cash flow. They have earnings, so they can do multiples on this to set a price. There's a lot of levers that they can control to create more value creation. There's a lot of governance and controls in place in terms of how they spend the money. There is a board, and there's a very credible exit. Strategic investors, we talk about the large checks also, might be a bit more different. It's less commercial, but more strategic in nature in terms of how is 1 + 1 equals to more than 2 kind of stuff, right? Like Petronas want to know what they can leverage off you to basically synergize with you to grow more into a sector, learn from you in terms of your R&D. So there'll be more of that synergistic stuff rather than just seeing you as a spreadsheet of dollars and cents. So what's also exciting about this, and this is where when we look at the last kind of annual report from SC, there was a lot of activity in terms of VC and PE last year because of this. The GLICs have been given this task to say, yes, you have to get us returns, you continue investing in amazing things in the global market, but they were kind of all given this little small must invest into Malaysia mandate, I would say that. And small in terms of a large, big fund, it's still quite relatively big. So we saw a lot of the GLICs directly investing in companies. So last year, you saw about 20 billion domestic investments. Sometimes they don't go direct, because when a GLIC, let's say a Khazanah or a QAP or EPF goes direct to you, it's the same effort to write a small check versus a really large check. So they want to just write really large checks. So if you are a company are asking for something smaller, they normally won't do that. They would go through what you call their fund managers. So this FOF here stands for Fund of Funds. So most of the GLICs has a fund that they provide to other fund managers, and these are called the general partners of the fund, and they will deploy into company. So things like, if you heard of Jelawang Capital, so that's Khazanah's fund of fund, and Jelawang Capital gives money to people like Kairos and Vin Capital and First Move, and they then find companies to invest into on behalf of them. So this is how you would still get GLIC money, but smaller checks through the managers. And of course, the GLICs directly invest into public markets too. And if you see, a lot of the big IPOs always have a cornerstone investor that's one of the GLICs. So, and that's their duty they play to make Malaysian companies do real well and kind of benefit from it. So that's about 440 billion in terms of their public holdings in books. So that's pretty impressive. And one thing also nice, we would have heard of this if you read the reports, and the report card for this just came out a couple of months ago, or less than a month ago. It's called the Gear Up program. This is where all the GLICs are trying to figure out how to invest locally, and they build this thing called the relay race, which is quite interesting, how they're all playing together. But of course, when they hand it off, it's basically always a fresh new investment decision, not just simply trying to make something work. In terms of venture to early growth to mid growth to later to IPO, they have a series of funds that are helping find companies and move them through the escalator. So this is where, it's really interesting that if you get to a certain size, like QAP invested directly into companies like La Pasa and Battery Cool. So now, by them growing those businesses, they would have access to bigger GLIC funds and eventually being a listed co and them coming in as anchor investors. So it could really give you the pathway to being a really amazing local business itself. And this is what the GLICs are basically trying to do because of the mandate coming from a top down. So it's nice to basically see that. So Jelawang was one of the funds by the GLICs. This is a fund of funds. They have what we call a emerging fund manager program. And we see 3 funds under there, Vin, Kairos, and First Move. They all focus on different things. So your job again then is to do this research, right? But I'll give you a quick glimpse. So Vin Capital does a lot of supply chain investments, especially in the mobility space. Kairos likes cross-border stuff. You're trying to break into markets like East Asia. You're trying to get into things like Taiwan, Korea, China. They love stuff like that. First Move is very consumer-oriented products you basically want to invest into. So if that's the kind of business you're in, go speak to them. This then is the more regional fund manager initiative that they basically had. They had a Taiwanese accelerator and a Chinese fund. They basically are looking at companies. I think AppWork does more blockchain, Web3 kind of stuff. Granite does big Chinese kind of investments. So if you're trying to get into China and basically scaling there, then that's their specialty. But Jelawang is a fund, so they don't directly invest. So don't go pitch to Jelawang. If you have ability to speak to Jelawang, then maybe they will connect you with one of the funds, but they don't invest, right? So for Quap, also they did a lot of these incentives around creating direct allocations with Dana Perintis. They had about 500 million allocated. They spent 50% of that directly going into venture capital like deals and 50% of that into venture capital funds. And they were targeting early stage Malaysian startups. So this is where they invested in Battery Coup based on this. There's Dana Pemachu. This was a little bit more bigger, private equity, trying to do infrastructure and real estate. So things like semiconductors, etc. They have funds around here. And then they have the whole kind of PE buyout funds where they're trying to get into certain sectors. So I know they would spend a good amount to buy if you are a chain of clinics, hospital, or if agriculture, education. So they're trying to find one anchor. They will buy it out with a fund, and then they invest alongside into other businesses that plug into that infrastructure that they basically build. So it's very interesting to see how they approach different sectors, and they have an idea in terms of what's missing in terms of the market, and they build businesses around that. So at the end of the day, you don't need to knock on the Glick's door if you are still quite small and not raising more than a 20 million ringgit check. You go through the fund managers. And again, we'll give you access to the slides. So some of this information is hard to come by because they keep it very PNC. But lately, with the new report cards coming out, a lot of this stuff has become public information. So here's some of the information in terms of what are the names of the funds from a VC and a private equity, for climate, for real estate, direct investments, or if you're going to IPO and you want some of them in, these are the funds that basically invest into you. So same thing like VC, you want to create that funnel, you want to create a filter in terms of what stage you're in, where they invest, are they aligned, are they in the sectors you want, what is the check size they do, and what's the best route to speak to them, direct or through the fund manager. And then you knock on the doors. Don't just randomly knock on every Glick's door. So end of the day, you choose the capital based on the obligation, not the popularity, right? If you want non-dilutive because it's still early, get a grant. If you want debt, you go to a bank, or you can do with P2Ps. Equity, broad range these days, directly to angels, you can go to VCs, you can go to ECF, you can get private equity invested into you. But the key thing is know what they basically want to have and what you got to watch out basically for. All right. So here's an activity for us to basically do on your free time. So think about it, right? If you are a pre-revenue SaaS-based business working on MVP, no paying customers, you need 300,000 for validation, what would you use? If you're profitable SMEs, what would you basically use with 8 million revenue and you have some net margins and you want 800,000 for inventory? Or if you're a manufacturer with 20 million revenue and you've got confirmed demand, but you need 5 million for automation, which would you use? So first one, of course, you don't have money yet, you're pre-revenue, so you always have to figure out whether you can get access to grant, angel, or pre-seed from an accelerator. That's always going to be the best. For the SMEs, if you already have certain kind of revenues coming in, always safe to go for banks or P2P or some kind of invoice factoring for that. But if you think the payback from those equipment is going to take a while, then basically you want to figure out how to equitize that. And for the last one, with that kind of CapEx need, you could always leverage COSIF. And COSIF could be ECF. COSIF can also be P2P. So one thing nice about COSIF with P2P is on the government portion, the matching, they give you lower interest rates. So I think effective interest rates from COSIF will be about 2.5%. So blended with what the fund platform gives you, it would be maybe 5-6% of interest you'd basically pay on a 10 million loan. So it gets really attractive on these things. So the third part is about funding following the proof, right? Where, investors don't invest in slides. They need to see evidence. So that's the key thing. Every milestone that you go as you grow across the journey of a company, there are things that you will de-risk. Like the first part is like, what's the problem? Do customers care? And then someone basically funds that risk and then takes it to the next one and it gets de-risked over there. The problem's been solved, but as the solution works. And then, okay, solution works, but would people pay? And then can this basically scale? And can this be repeated across, different markets, different products? So the risk keeps basically reducing. And therefore, then what basically happens is your valuation basically goes higher. So that's the kind of risk reward trade-offs that you basically see. So investors need to believe these six things generally. One is the problem. They need to understand that this is something urgent, it's valuable to basically be solved. They need to make sure who's solving it. Is this team able to win and pull this off? And then if you do this, then how big is the market? Is it just something for here, or is this something translatable to a larger audience, global if not? So that's the key things first. And then eventually after that, it's about seeing whether is there already some traction? What is the risk? And is the risk being reduced? Is it falling? Is the economics something that can create value and can compound over time so that every time I enter into a certain point, it's always going to be worth more as time progresses? And then can there be an exit? What is the returns that possibly can be realized? Who would be someone that takes this out by M&A, or can this even IPO? I think that's the key things they want. But if the market's not large enough, then how do you IPO a business that can't get towards at least 6 million in profits? So the traction that people evaluate are very different based on different sectors itself. If you look at SaaS-based products, we look at monthly recurring revenue. They look at retention, they look at usage, they look at your CAC, which is your customer acquisition costs. If it costs me 10 ringgit to acquire a customer, when do I get the 10 ringgit back? Is it immediately, or it takes about 2-3 months for someone to basically subscribe to services to pay back the customer acquisition costs? So if that's a very nice positive unit economics, then great, it's a viable business. But if retention is bad and most people die off after a month, that means there is a chance someone doesn't pay back the cost of acquisition and they die off in a month, and then we don't have the remaining 2 months to recoup. Then the math is very lopsided. So the traction is really important to kind of justify if this is a business that's viable to invest into. From a consumer perspective, let's say in a B2C business, it's about repeat purchase, it's about gross margins, it's about which channel has the best velocity. Have you tested as many channels as possible that most sales can happen through online or offline or through TikTok or through subscription? You have to show that you figure out multiple channels and which one works best. From a traditional services-oriented business, then it's about the contracts, how many active contracts, how long these contracts basically are, what are margins, and how fast do you basically get paid, and the receivables. For marketplaces, I mean, I wouldn't say the best time to create a new marketplace is now. Most people don't want to fund marketplaces unless it's something really niche. But it's about the take rate, right? The margins, the repeat rate, how often someone comes back and buy, and how are you going to differentiate things like Pindodo and all this stuff in the market. So it's very competitive. For hard tech, it's more the milestones from going from prototype to something that can be commercialized. I think that's the key thing. Can you show that you've gone beyond that? You're getting pilots, you got certifications, and the cost, that's the key thing with hardware investments itself. Initially, because you don't have the numbers, the unit cost is pretty high. So how fast or how little do you need in terms of getting scale to bring unit costs basically low? But traction that are very much vanity metrics, like number of followers I have, number of downloads I have, people will not kind of look into that. But I guess sometimes you could say conversations you have could be interesting. If I'm a pre-revenue company, what traction do I have? So it's about proving that this solution is needed, this problem is real. So if you go out and you get letters of intent, it's not revenue based, but at least certain number of people say they want to pilot if you can build it. It is still better than nothing to show some form of traction in terms of belief from a customer. So from a capital fit, not every business is ready for VC or venture base. You could be a good business by saying, you've got profitable niche, you are growing steadily, you've got great dividends, but then it's not venture backable just because in terms of how big the market is and how fast you basically grow. But this would be a great business to get an angel investor in. This would be a great business to go on ECF to say, I can give you interest rates that are better than EPF. Give me $1 million and I can pay you 7% dividend annually, which would be lesser than you would pay in terms of interest to a bank if you don't qualify for one of those business loans that go about 3 to 4%. So it's about leveraging those things. Venture businesses, like I said, it has to be really large, has to be something that can scale really fast. Maybe we don't want dividends in that. We want you to reinvest all the money. If you have money, reinvest it and grow further. It basically needs to have this strategy to basically be able to exit via a takeout by a strategic partner or an IPO at least, right? So in terms of investors, when they look at the pitch deck you send them, what's going on in the first mind, the first 10 minutes? They might even spend less than 10 minutes into a pitch deck. They're not going to read it like a thesis to say like, oh my God, I need to really understand this deck. If they don't get it, they just move on to the next. So it's about, do they understand the problem? Is this team credible? Why? Because that's something, again, we do on our side, right? If we see the idea wasn't really that great, was half baked, we still always look at the team and say, you'll see us traversing your LinkedIn profile saying, like, oh, wow, but the team is amazing. These people do this, this, and this. Why is the approach this way? We will still want to call you in and have a conversation to figure out what was the reasoning in terms of this approach. Could you convince us otherwise, or we could convince you for a pivot if it made sense? Was there proof already that existed why this approach you took basically make more sense? And then asking ourselves, will this be large enough? What is the round going to be after this? Why is this round important? Are we here because they couldn't get the main round and the last round didn't last? So what was missing where this round we're coming in to kind of keep them afloat? We don't want to do that. So your numbers must tell a story, right? And you must tell one story consistently. From a historical perspective, can you declare revenues line by line? Show us not just one lump sum, but where is the money's coming from? How many revenue streams do you have? And then it gives us an idea whether are you trying to do too many things or where should you emphasize certain things? What is the gross margins? What's the cost of operating? Cash and debt, how does that look like? How much is in receivables and payables? Gives us an idea in terms of how the ship is running. And then in terms of operations, we want to know things like the customer cohort analysis. Now, this is something really difficult to do, but with AI and certain analysts or rather analytical tools you have like Google, etc., makes it a bit more easy to analyze as a group of customers come on. How do you analyze them as a group as they progress from onboarding to where they are 3 months down the road? How many people in that cohort still exist and still use the system? How many people drop off? Those gives us a lot of ideas in terms of how sticky is the product. We want to look at unit economics. It's fine if you're cash flow negative, but we want to ensure that unit economics, when you sell products, the unit economics is positive. Of course, it'll be cash flow negative if you don't have enough sales, but those are fixed costs you have in terms of staffs. So eventually, can you sell more than what you spend? And then basically then the break-even point is there, right? So, but if every product you sell is a loss, then you're never going to hit the break-even point. So these are stuff we basically want to know. What's the monthly burn? What's the pipeline? What the conversion is? Again, this might be more for slightly mature companies that has that kind of data sets to give us. But if you don't, then they'll be evaluating you from different perspectives. And then the key one is always forecasting. A lot of people have a hard time doing this. It's not just about showing us that hockey stick or the S curve, but the assumptions on why you think this is going to happen. How do you think the funds are going to be used to make this happen? How long is the runway you need to get to that next milestone itself? And what's the downside case? So don't just show us the best case scenario. We want to see business as usual, what is best case, and what's the downside case, so we can basically know what we're getting into, right? So again, back to the data room. All this information has to be at your fingertips to basically be there so that when we ask for it, it makes the decision really fast to decide whether we want to invest into something or not. If it's not there because it's not part of the norm of things we need, we will request for that. End of the day, when people do due diligence on the data room, there might be certain things we find that this sounds strange, but if you can explain what it is, then we say, all right, that's certain things that were misinterpreted, fine, move on, we can proceed. Certain things that are missing, we could say it's curable, where it puts in as what we call a CP, a condition precedent in your term sheet. Things like you're a high-tech company, where you notice all your employee agreements doesn't have anything about ownership of IP. So we might say, for this term sheet to be valid, you need to fix all this first. I want every employee to have a new employee agreement that re-signs it with these terms basically in. So they give you this whole list of things that you need to basically show. Customers have to sign a certain SLA or this or that. It could be anything that's curable. But then when it comes to this kind of red stuff there in terms of economics, the margins weren't great. Your forecast was always weaker than it's in your actuals always weaker than your forecast. We noticed that there's certain debt issues. Then we might take a risk to say, maybe give you money in tranches, not one lot, in case something happens. Or we could say the risk that's coming in is not worth the equity we're holding, lower the valuation. Again, this is the willing buyer, willing seller. There could be issues around control, governance, legal. Then we might have some kind of indemnities that don't tie us into this. Warranties we basically want, or some reserve matters that say every time you spend this checks, you need to get our permission. We need to know what you're writing, when you're writing, why you're writing it, right? So when it comes to something that's classified as fatal, there's fraud, there's dispute, there's no trust, then we basically will guarantee walk away from the deal. All right, two more parts. So structuring the raise. The idea is you want to work backwards for things like this. You need to know what is the destination you want. What's the milestone that's going to change the company, whether it's, product being created, 100 customers, certain certifications. So then work backwards. What's the plan to get there? And based on the plan to get there, what is the cost for you to have the resources to get there? Then eventually, which capital makes sense for that amount? Do you take debt, you take equity, or it's not time boxed and you can wait for a grant? Then eventually you know how much you want to raise, and that's the round you basically need. And you have a sense in terms of how much you're willing to part with your company or pay in terms of interest for that specific round. So it has to be done in this process, not just I need $1 million and let me go find $1 million. It doesn't work that way. So how much do you raise? The use of funds specifically, try and not have just percentages, but the actual number, how much you need for so-and-so task. You want to also make sure how much runway do you need to survive to get to the next point of time. Whether there's certain contingency, then minus whatever cash you have internally, because if you have cash, you want to leverage it, don't just simply equitize too much. Then that's the capital required to fund that milestone. And not just merely, just to say for 6 months. It has to be in 6 months, what's going to happen, that milestone. So here's an example. If my destination is get towards 20 paying customers in the next 15 months, because this is a enterprise sales, it takes a while to close them. Each one gives me 100,000 in monthly recurring revenue. So that means I might have a couple of customers already or starting to, I'm going to be having some cash. So that's great. I don't have to be dependent so much on the raise because once I get there, I'm also making money. So the plan is I've got a few pilots. I want to convert it. I want to finish some of the product, hire a sales team. So the cost might say, I still need about $500,000 left to build this product. My runway to keep the people going is about 600,000. And maybe I have a buffer for 150,000. So that's going to be about 1.25 million. Capital wise, you can say, look, I don't know if this can be debt because that's a burden for me to pay monthly. And maybe I don't get to close the 20 customers. So I'm not going to take the entire 1.25 in debt. So I might say raise 1.1 because the buffer, 150,000, I might have that internally in cash already. And as I get recurring revenue monthly, I can basically say that the buffer is something I can be confident I get on my own. So just give me the money for the bill and the runway. So 1.1 million is what I want to raise. And that 1.1 million should last me about 15 months to do that task. From a dilution perspective, this is again then willing buyer, willing seller. You could think about this being a good round, therefore 20% maximum, but let's open the floor discussion at 15% and see if people bite for this. Again, this is still an art of negotiating. There's no science in terms of how you set the valuation because if you do a DCF model and you do the math models in terms of valuations, it does not work for pre-revenue companies because there is no historicals. Everything is an assumption. So how do you price something entirely based on that? So that's where people want to know, what is the next milestone after this? If you can achieve 20 paying customers paying 100,000 MRR, what does that mean in terms of the business going to the next milestone? How much is going to be worth? Is my 15% now underpaying or overpaying or a fair price? That's what the discussion will be on. For an SME, it could be more on your destination is hit a 12 million revenue. You want to get into 2 national retail listings in 18 months. So the plan is in my factory, I'm adding a new line. I'm trying to expand into some kind of national distribution centers. Therefore, I need to hire key accounts to close these retail listings for me. The cost to build a line will be about 1.4 million in capex. I've got maybe a 700,000 working capital thing that I need and quarter of a million in terms of a buffer. So the capital I will need because I might be already revenue generating because it's an existing business. I could say, let me do half and half. The capex, I want to do some form of debt, but certain things in terms of growing, I want to use equity. Maybe I'll do ECF. So you might have some cash internally. So you'll say, let's just raise 2 million. 1.2 million was on debt, and the 800,000 will go to ECF and we'll dilute ourselves 8%, or we can think about giving a dividend rate of something lower itself. So you can play around with that. That's the idea. The percentage part we'll talk about after this. So the valuation will change as your business mature. The more earlier you're in, the more less evidence you have on valuation. It is going to be different kind of proofs. The proofs will be on the team, the founder market fit, the product proof, the comparables of someone like you starting in other markets and what was that price eventually. So then it's then how big is this market? Can this be a discount of what the other company looked like in the other market? Those are the ways you would analyze some form of perceived valuation. If you're early revenue, then okay, there's some kind of revenue growth. There's some kind of margins in unit economics. We like to look at the recurring revenues from an annualized and maybe take a multiple based on that. But again, early revenue startup means it's not profitable. So you can't say compare with a listed co and this multiple is 15 times. That's 15 times on earnings. So you can't just take that number and multiply with your sales revenue. People will also say it's too far-fetched. So at the end of the day, it's about what that number is and what that equity portion looks like and what that risk sounds like at that point of time to the investor, whether they think it's going to grow more or not. So this is where we'll come into the next instrument in terms of how do we de-risk this? For profitable SMEs, it's going to be a bit more easier, right? There's always the comparables of a multiple on profit after taxes or EBITDA, and there'll be some kind of comparable transactions in your industries to basically look at. And you could safely do DCF models in terms of businesses at this size to come up with what an enterprise value of the business is. All right. So this is where now it's becoming mainstream. More companies, especially tech companies, are using what we call safes. So this is where it means it's a agreement where you give me the money today, I'll give you the equity tomorrow, or rather tomorrow here being generalized for further down the line. So typically investments work by saying, give me money, I give you shares. That's called a price round. The share price can be determined right now. Investor ownership, it's fixed right now. We sign all the documents to basically give us the shares and it gets filed in SSM. It takes time and it takes some money to basically put all these things together. When it comes to safes, we call this post-money safes because it's based on the post-valuation amount. It's about giving me money now for something I can't agree on the price at the moment because I'm early stage. If I set a valuation too high, you're overpaying. If I set a valuation too low, you're underpaying it. So we'll say we will convert the shares later in the future when we can agree on a price round. The price round will be determined by institution investor. Once I have sales, I have revenue, I have earnings, then we decide. But what keeps it now safe in terms of an investment is two things. There's this thing called a valuation cap and a thing called a discount. So valuation cap is an amount that you set as in it's the highest amount the company is going to be worth. So in future, let's say 12 months down the line, 24 months down the line, the company is worth higher, the investor will always convert to the valuation cap, which is a lower valuation. These days, some people are not doing discounts anymore, but if there's a discount, whatever the valuation is in the future, that discount is applied. And this is typically 10, 15, 20%. If the discount price is now lower than your valuation cap, the investor will always pay or rather convert to the lowest rate. So this is a way you can guarantee that early investors coming into the business always gets a good deal. So you don't set the price too high so that when the next round happens, there's always an uplift in terms of their paper gains. So if I come in now and evaluation is just say 3 million ringgit, when you convert your 6 million ringgit, I convert at 3. Because the price today is 6 on paper, I just made 2 times my money already. It doesn't mean they'll exit and ask you to pay. It's just on paper, I have gains. So that makes the angels and the early stage investors really happy. So with the cap, I mean, you can't just set arbitrary numbers, right? Let's say if I'm raising 500,000, I can't set my valuation cap to 1 billion because if they convert, you give away 50% of the business. Doesn't make sense. If I do it at 20 million, that means I'm giving you 500,000 now for a business that has nothing, and you're worth 20 million. If I convert at this, I could only be worth 2.5%. That sounds too ridiculous too. Like I'm overpaying and I'm taking all the risk for you to get all the gain. So it's about finding that sweet spot. So let's say if it's 5 million, the ownership now is 10%. It sounds plausible. But again, what is this number? There is no science to this. It's more of an art and a willing buyer, willing seller. So you would have guardrails in terms of what is the maximum ownership you want to give out per round. You need to know, again, as I keep saying, you need to know your milestones. Based on knowing the milestones of what you need to go from here to product, product to scale, scale to whatever, you would know how many rounds you have to raise and how much you're going to dilute per round and how many founders you have and how much you want to be at a certain point of time. So if you give out too much too early, you're going to basically be dead in the water. You give out too little, nobody wants to invest in you too. So you could imply by saying, look, 10% is something I don't mind giving out now. So that implies a valuation of 5 million for 500,000. So the lower your cap is right now, the more you're going to get diluted eventually. But it basically will say if you set it at a pretty low amount, you protect your room for more future rounds because there's more equity for that. From an investor standpoint, of course, it's not going to be a very transparent conversation. Internally, they will always have that minimum they want to hold, right? If they know that, okay, this portfolios, we're going to come in early, we're going to hold on the longest, there's going to be so many rounds for them to raise, I'm going to get diluted 3 times. I want a good chunk. So that could be whether they want 5, they want 10%, depending on how much they're putting in, they will have an internal number. So when you go to them with a safe, they look at that number, they will know whether you're in range or not. So in this case, you are between, they're willing to pay up to 10. They're not going to tell you that. You want up to 5. So you come with 5, they're going to say yes. But there's room to, of course, negotiate if it has a higher opening. But I'm not saying going out in the market with higher sales, right? That's also going to be detrimental for you. The evidence they'll ask you for is, why 10? What traction do you have? What risk do you already have that's de-risked? What demand is there? So if you can't show this with evidence, then people are not going to bother. But if you had already a lot of people invested in the safes and they are very known angels, then there are lesser negotiation for the later investors coming in because they go like, if everyone agreed, why aren't you agreeing? Then you just walk away and find somebody else. So typically they start off with something like this, right? You need so much money, you have this budget in terms of giving out equity, therefore that's the valuation cap. Then you be very specific in terms of the fund usage. What is this going to do? And if I get my product done, I got my buffer, I got my go-to-market, will the next round be 10 million, 15 million? Can I get a 2x on this? If I feel it's far-fetched, because as investors, we do a lot of safes and we know how fast certain safes can basically grow and get towards a valuation cap in the future for certain sectors, we will say that there's no way I think you're going to get to 15 million in the next 2 years. I think the entry point is too high. I'm only willing to pay 5 million or 4 million. And it's up to you whether you create a different safe for me or just say, too bad, then we part ways. So the conversation starts like that, right? Because eventually, as you go from one safe to a seed price round to a Series A, averagely, you're going to keep diluting yourself. And this is something you need to keep track with an Excel sheet. And there are software services out there, things like Carta, etc., that allows you to keep track of your cap table. Because if you lose your eye on this and you get too excited because you keep rising like your 4 or 5 safes before you get to a seed round, you tend to forget sometimes on conversion how much you truly basically would own. So this is something you want to be careful in terms of tracking your ownership across the different rounds itself. One benchmark people always use is Carter, but be careful on this. For Carter, if you look at the amounts, right, raising less than 500,000, it's very US-centric numbers. The typical cap is about 6 million. The more higher you raise, of course, the caps are higher in terms of saying pre-seed, seed, and close to Series A. This is not representative of Southeast Asia. You cannot say, oh, 6 million means convert times 4, your cap for pre-seed is 24 million. Not going to happen. Can you say it's dollar to dollar? Maybe can, maybe cannot. So it always comes back down to, again, the sector you're in. Fintech companies might say that they're worth a little bit more higher because there's a bit more exit transactions on that. If you're trying to do something on AI, again, depending how deep AI is, I deliberately didn't want to show you the new caps for Carta, because if you look at the Q2 caps for AI companies, it's gone to even $100 million valuation caps. But again, you might see more crazy deep tech solutions in the US versus here. So it is always going to be willing buyer, willing seller. But I just want you to understand the notion on how these caps work and how the negotiation basically works itself, right? So price rounds happen later point where things are more predictable. So if things are not predictable yet, and it's not a large amount that's coming in, you may have to do another safe. So this is where I've seen like some of the startups did 4 safes. They do a safe per year across 4 years before it gets to the point where they can justify the valuation they want and ensure all the safe holders gets converted on a multiple at least more than 1 or 1.5. So that's the trouble by setting your cap too high now. You're going to feel the pressure of people saying, wow, we came in to support you from early days, and now the cap is basically going to be a down round, and therefore then you're going to suffer in terms of the conversion. They're going to lose trust in terms of how much they stand to gain too. So these are stuff you want to basically be aware of. One thing good about safes is it's fast. So if I'm raising ringgit 1,000,000 in safes, it's not I find one person to give me 1,000,000. I will create the safe documents for 10 people. Each one gives me 100,000. And if they want to give me 100,000, they transfer it into your bank account straight. It's not like crowdfunding where you have to wait for all 10 to accumulate the 1,000,000, then you get it. So that's why people do safes, as in they hit the ground running. You're raising every week, every bi-week, every month as you hit the 1,000,000 threshold, and you're basically growing. So some people, what they do is, because the safes are like a living document, the safe thresholds keep moving. They'll go to investors and saying, look, I'm raising 1,000,000 across the next 12 months. First 6 months, this is my valuation cap. Next 6 months, this is my valuation cap. Because you come in now, it's more risky. It is only going to be 3-4 million, the cap. You come in after 6 months, I'm going to basically say it's 7 or 8 million itself, because I've done the bulk of the work. The biggest risk in terms of prototyping and getting a customer is done in the first 6 months. Now it's easier. So you want to de-risk, you pay higher cap, you come later. So again, then it becomes the art of fundraising and how you talk to investors itself. This is what you need to learn on how to do. Shouldn't be teaching you this, then you're going to negotiate harder with me. But anyway, once a price round happens, you set the price, a term sheet's issued, all the past safes has to convert, and that will be part of the new shareholders agreement, and then you issue shares for the new money coming in. So that's where safe holders will always be waiting for this point on when conversion happens. Hopefully it doesn't happen too long, so that they don't feel like they've lost hope in the business itself. When you ask for fundings, the clear thing is always be clear in terms of breaking down the milestones itself. You want 1 million, you want 2 million. Try not to just say, I want to spend 30% on marketing, 40% on development. Be specific what each particular milestone is of that round in terms of dollars and cents, and what is the outcome. The key thing, of course, we're not going to hold you to this, but the idea when investors sit down with you and look at stuff like this, it shows that at least there's some thought process, and then they can have a conversation like, why 150 paying customers? Why not 100? Why not 300? And then you talk about how much it costs and what that comes in and what revenues this will translate to. It gets you in the territory to basically be, $300,000, ringgit. Therefore, I'm good seed, and then I can convert the next round. So that's the conversation people want to have in terms of why are you asking for this numbers itself? And the other part of valuation is, of course, this terminologies, right? If you're raising 1 million and you're saying, the question will be like, okay, what's the valuation? And you say 5 million. The question always will come back is it pre or post? Because it means different things, right? If you're post money 5, it means today you're worth 4, which you have to justify. With the 1 million coming in, then you're worth 5. So at this point, when I see the valuation is always post, I know I have more equity because now I get 20%. But if you said 5 million was the pre-money, you're worth 5 million now, you're raising 1, my post money is 6, then I'm going to walk away with lesser than 20% for sure, right? So this is where investors want to know the justification of valuations. Why is it pre-4? Why is it pre-5? How are you coming up with this? But if you cannot agree on the actual valuations, this is for price rounds, that's when you just say, forget this. Don't waste your time. Just create a safe set of cap and then go out there and try and see who believes in you and who wants to come in early. And then you get towards evidence to then eventually do a price round. But this is where most people are moving to safe instruments. One thing you also got to know is a safe was a very American thing. In the eyes of the law of Malaysia, a safe can be deemed, willing buyer, willing seller, not legal tender. Sort of like crypto back in the day. You could own it, but if anything happens, you can't take this to court. So safes, it's not something any startup could just create and go knock on the doors and raise. Although they do, and most investors today are okay with that. But safes are ultimately like a debt-based product, right? Because you haven't converted my shares yet. So the key is, isn't this like lending you money first? And lending is a very touchy subject by regulators. So in Malaysia, technically, only VCs are allowed to issue safes. A startup shouldn't take a safe and start just asking people to invest because that's, again, deemed like crowdfunding and deemed illegal. But as long as nothing bad happens and people don't take you to court, then fine, like everyone's happy. But it won't be recognized as legal tender in some sense in cases. So what's happening soon is safes might be carved into the capital market guidelines. That's something we've been proudly working with SC and writing the papers for. And that should maybe come out end of this year, if not next. And we're also going to look at how on crowdfunding, we've been convincing them to do crowd safes. So you wouldn't have to equitize your raise. You could publicly create a safes on any ECF platform, get angels and everyone to invest, not simply put a crazy valuation like everybody else in the ECF market today, and everyone basically rides that and does well. So we're hoping that will be announced by end of the year. Let's see. So end of the day, the valuation will rise as your risk falls and your upside grows. So what does that mean? To show that you can reduce risk is to prove that there is demand, there is revenue, the revenues repeat, your margins are predictable, your cash can be converted, you have assets, you have product, you have inventory, you know how to sell it and always make money. The team is great. They have great governance, they have great control, you have IP, you have licenses. So all this stuff reduces the risk of operating across time, therefore building value in your business, and hence why value goes up. The idea is also to keep showing it can go higher and higher and higher, is to show that there is bigger upside. That means the market has to be bigger. Can the market be beyond Malaysia? Can you show you can go regional, you can go global? You show that this is a repeatable engine without spending, same amount of money in another market. I can hit the ground running and expand faster. So this is then giving you the credibility to show that this business can scale. And the key thing why this kind of entry valuation matters is, if I come in something that's priced too high and the exit is not that high, I might not make anything or lose my money. So just saying for this, I put 500,000 at a 5 million post-money valuation, I get 10%. Assume the business doesn't go that far and we get an exit offer for 10 million, at least I can still make 2 times my money back. That actual amount I get to return to investors, and the balance I can basically have some form of shares on it. Or if worst case, my fund didn't do well, I get to return even more money back to my investors because that's what I want to do first. But if I came in at 500,000, 10 million post money because you insisted and I FOMO, I agreed on, and you only exited at the same price, 10 million and not lower, I would just get the same money back. It's like the money didn't work for me, but at least I got my money back. But most of the times, these cases become I don't get my money back. I put in something and I get lesser. And this is where then investors today will kind of rather hold on to the money because they don't lose money that way and wait for something really safe to invest into, like more mature companies. So this is the kind of issues we faced on early side investments. The dilution compounds as you basically go round to round. So don't forget that typically, every round was 20%. So keep your eye on to how much you basically raise. The more you can do with less, such a cliche, like you are revenue generating, you're spending your money, you're bootstrapping to increase value, and you don't always have to raise to basically get to the next milestone, the better it will be for you from a founder perspective, right? Coming to the last part in terms of fundraising as a process. So the idea, as I said, is every funder has different definition of success, what they basically want. You want to ensure that you go find the right funder for your needs so you don't simply put pressure on yourself in a very early stage. You shouldn't be going to really big VCs so early, even though if you can, the pressure is on to always get the exit as fast as possible. Leverage angels, leverage ECF, leverage then VCs. Then if you can have a kind of balance between debt and equity, figure that out. Because end of the day, when you want to raise, you would only have a few people you can basically go to. So you want to ensure that you work backwards. When you say you work backwards, you need to figure out when do you need the money and what is the pipeline of investors you have to speak to. Because, when we raised, wow, what was it, about 10, 12 million ringgit check for one of the startups we had, took us 18 months to close. Hence, when cash flow will be an issue, and you got to figure out how to do some debts in between, and founders had to come in and help another founder, or angel investors had to come and take trust that this is a company that will raise and will pay you back and give them the money now. So you'd want to make sure that the process that you get into starts as early as possible, because the due diligence these different instruments take varies, right? So if 3 months before the target where you need the money, no one has offered you a term sheet, no one is doing due diligence on you, there's no way you'll be able to raise in such a short time, right? So when you send out that message to us or any investors, don't just send generic emails. Sometimes we actually take the time to read email. In fact, every email comes, we'll of course scan it. So we want to know, why are you sending it to Lead? Why are you sending it to Gobi? Why are you sending it to 500? Why did you pick them itself in terms of, because what you know about their stage and their investment thesis, something about their portfolios you want to work with and learn from. Then it shows you did your homework and we feel appreciated, like, wow, this person knows how we can add value and not just a check, right? You talk about, of course, you attach the pitch deck, but you can have some simple things about a quick 1 line or 2 line summary of what you are. So straight away, we can know whether, hey, this is not something I would do or not. And at that point of time, we might reply quickly saying, sorry, it's not in our mandate. Whether there's specific proof points you have in terms of your traction, your milestones. And then the clear ask what you basically want from us. From a deck, which we'll spend good time on this, I think next week talking about this, but it covers pretty much the cliches, right? You want to spend most time on the problem and solution, because that's where, if we're early stage investors, this is what we're looking at. We're looking at how someone solves an existing problem differently. How much do you know about a problem that others don't know? That's the key things we want to see, the vocabulary used to explain this, to feel like, oh, wow, this person gets it. But if it's a late stage one, of course, it's about traction. You'll bring the traction as much as possible to have that as a summary on the first page saying, been around for 12 months, made this much revenue, this much profits, this much traction. I want to speak to you about how we did it and why we did it. So it's about leading with your best foot forward when you basically create the pitches. So, of course, if someone's interested, it's just the start of the due diligence. Doesn't mean like, the girl smiles at you, she wants to marry you, for God's sakes. So there's so much things that has to be done, as I spoke about before, in terms of the follow-up, the diligence, the term sheets, the closing. So the more you understand this process, the more you appreciate the process, the more you can work with a venture team if they are interested to make the process actually become worthwhile for you to become a term sheet. So if you don't play ball and you don't have the information, and every time you ask, it takes a while to basically get it, then of course it's going to be a very slow process itself. So your job is, as you reach out to multiple investors, how do you know who is where in what part, and how do you support all these different queries? So You want to keep a tracker. I mean, tracker can be basic Excel. When was your last interaction with them? Even if they said no, but they're in your sector, maybe it was no because it's not yet. You're not in their radar yet. It doesn't sound like you had a big market yet. So this is where then you want to keep everyone up to date. As you progress, write your fortnightly, if not monthly newsletters in terms of your achievements. Send it to everyone. This is stuff that most of us always keep an eye on, even if we said no and we see progress and traction, maybe it comes to the point again, it must still be in our mandate to invest in this. We feel like, wow, this sounds like it's de-risk. Let's call this person in and chat more. So that's stuff that basically works for you then. In terms of fundraising mistakes, the typical thing would be, raising the wrong type of capital, starting with too little of a runway because you're so desperate, you just want something small, but then it's going to die anyway. So that's stuff you got to be really careful. You're just using some arbitrary amount for your valuation or what you're asking for. People can then tell you don't really know where you're heading. You're approaching and knocking on investors that don't fit, and most VCs know each other and we talk to each other. So it doesn't look good for yourself, like you don't know what you're doing. The numbers don't reconcile. You're treating interest as commitment. People always get excited. A VC asks question, then you tell everybody else, I already have a commitment coming in. And then we know who it was, we'll speak to them and they'll say, there's no such thing. Again, it looks bad on you, right? So don't negotiate just on headline valuations. You got to be open in terms of how this is basically fundamentally achieved. And stopping the business while fundraising, right? There's people can't do both. So this is going to be an issue for you in terms of saying, hey, keep the business running. Someone has to be in charge of investor relations. A founder has the double hat. This is going to be a struggle. And eventually, this is why certain people will have a key person in the business that focuses on investor relations. So try and have this into like a 90-day plan out, right? In terms of diagnosing your company, knowing what the milestones are. I mean, you might know it, you just never documented it properly into a proper form, having some kind of quantifiable numbers to it. Choose what's the right capital, fix your numbers, adjust your cap table if certain things needs to be cleaned up over there. And then it's about working further in terms of building that model out. Like, what is the use of funds? Can you project these things? Of course, your pre-revenue, some of these things might be too early. This is more for later stage or the non-tech companies. What is the assumptions you're putting around this? Build that data room, just a Google Drive with all the folders in terms of the documents it basically needs. And then create that target list of companies or funds or angels on LinkedIn you found that you want to speak to. And then it's about executing, right? Start the conversations, track it, get feedback, improve, and then eventually hoping by that timeline you need the money, that's something that's already in a due diligence process that wants to give you the check. Hence why we're saying for early stage, you not want to go to institution as early as possible. You want to leverage angels because it's people, and people might still have some level of fact finding they want to do, but when they write the check, it's less of hoops they get to administratively, so they might be able to wire the money to you a little bit more faster. So last slide. So where do you basically find out all these funding options? Well, all the sites has all this tracked, right? So if you're talking about VCs and PEs, officially the entire list, including their contact numbers, is on a registrar on the SE website. It's publicly available because they have to tell you who's legit and what's their contact information. It's all there. Again, the details of the fund is not there. So then you do your homework. You go and research these companies in terms of going to their websites and seeing if it makes sense for you. For Cradle, for grants, everybody knows how to access that. For bank financing, some kind of new loans, SRF funds, Bank Negara will be the best for that. Some form of seasonal grants, then MDEC usually has these things come up for digitization and AI. So sector specific, there could be specific agency sites that talk about this, like even Mosty. And of course, what we have is a site called muruku.com, where we kind of maintain all the grants available locally, put it all in a one listing there. All the investors that has invested in Malaysia, even though they're regional. So you have a basis of that captive names to work with. And then the rest is on you to basically kind of do your homework to figure out which profile of investor works best for you, right? So end of the day, the money has to match with your specific milestone. And it's all about building the proof to the next option. Every time they see you can move the milestone from one point to another, then investors are really happy to work with you because you're helping them also get towards the exit and get their particular money, even though it's on paper gains itself, right? So if you love what we spoke about today, there's tons more of this kind of talks about fundraising, about pitching, even about how to go from idea to product. We have that talk. And all this is on our Alpha Startups program, on our Lead Academy program. So if you want to start an idea, go over here and you can enroll. It's fully free, it's fully online. So even if you need it, like to be in an accelerator but not join a physical accelerator, you can take your own pace on it. This is the program for you. If you have a startup and you want to pitch to us, and today you heard like, okay, I'm ready to speak to you, then Pitch Tuesday is where you want to go for early stage startups. If you're an SME and you want to chat a little bit more about the capital stack and you're not sure about whether I should go ECF or go to P2P or go towards an IPO, then scan the other QR code on the right side and we will basically speak to you and learn how to navigate that. Because we also run the program with SC called Elevate. If you're a high growth SME, we nurture you to become, someone that leverages capital markets, being VC, PE, or even an IPO. So we have all the instruments. So even if we don't have it, we know where they are. We would love to work with local founders and connect you with the right resources. So that's us from Lead Ventures. I hope you had time. I'm so sorry this went off a little bit longer. This was some new content we were also testing. So if there's questions, I hope we had time to take it through the chat just now. If not, we could stay around a little bit more longer and answer some questions. But if not, feel free to disconnect. And thanks for tuning in, all of you. Truly appreciate that.